we need to start the virtual. We're good? Perfect. Thank you so much. So welcome to day 2 of the conference on diversity, equity, and inclusion in economics, finance, and central banking. My name is Sermin Güngör, and I'm the Deputy Managing Director of the Economic and Financial Research at the Bank of Canada. We would like to begin by acknowledging that we are meeting on the land of the First Nations, Inuit, and Métis. We, here in Ottawa, would like to acknowledge that the land on which we gather is the traditional unceded territory of the Algonquin Anishinaabe people. We pay our respect to Indigenous peoples across the country and to their ancestors for their immeasurable contributions to this country. So today we have half a day of session ahead of us. The conference will end with closing remarks from Governor Pablo Hernández de Cos, the governor of Banco de España. But first, we begin with a policy panel on post-COVID challenges for women and underrepresented groups, chaired by Deputy Governor at the Bank of Canada, Sharon Kozicki. Sharon was appointed Deputy Governor of Bank of Canada in 2021 and shares the responsibility for overseeing the bank's financial system activities. Since joining the bank in 2006, Sharon has held several senior positions. In 2013, she was appointed advisor to the governor and served as secretary to the Governing Council. She was the managing director of the Canadian Economic Analysis Department from 2010 to 2013. Sharon is a strong and visible champion of diversity, equity, and inclusion in the bank. She is the executive sponsor of the employee resource group called New Generation, which is a supportive network for new bank employees for creating community among young professionals. She is also a member of the Women in Research community in the bank and actively contributes to initiatives in our DEI strategy. Sharon is also a mentor and a role model for many economists, including myself. I have received a great deal of good advice from her over the years through our conversations. And with that note, I'm looking to the conversation in today's panel, and I turn the mic to you, Sharon.
Thank you. So good morning. Bonjour à toutes et à tous. It's my great honor to moderate this morning's policy panel on an important and timely topic, the impacts of the COVID-19 pandemic on women and underrepresented groups and post-pandemic challenges. So by now, the story's familiar. Through repeated closures of the economy in 2020 and 2021, the global pandemic disproportionately impacted vulnerable workers. Women, youth, racialized persons, and low-wage earners were hit especially hard as schools, daycares, and the service industry experienced a series of shutdowns. Fast forward to 2022. At this point, we've seen a dramatic recovery of the economy, but an uneven one. Every time there were shutdowns, underrepresented groups again bore the brunt. And now, as we know all too well, the rebound in demand that we experienced as the economy fully reopened ran headlong into supply constraints. Of course, this has led to a new challenge, high inflation, one that also disproportionately affects vulnerable workers. To help us unpack this topic, we're joined today by a formidable group of central bankers. They will, among other things, discuss the future of work after COVID, the ways inflation puts different pressures on workers and families depending on where they live, what they earn, and how they spend, and how policymakers and businesses can respond. So let me introduce all of our panelists, and then we'll go through a series of 3 questions. So Lisa Cook is a member of the Board of Governors of the U.S. Federal Reserve. Previously, she was professor of economics and international relations at Michigan State University and a research associate, and a research associate at the National Bureau of Economic Research. Lisa has been on the faculty of Harvard University's Kennedy School of Government, and she has also served as a senior economist on the Council of Economic Advisors under President Barack Obama. Claudia Buch is the vice president of Deutsche Bundesbank. She is the accompanying person of the president on the ECB Governing Council and a member of the German Financial Stability Committee. Previously, Claudia was president of the Halle Institute for Economic Research and a professor of economics at the University of Tübingen. Sorry, I'm mispronouncing that, I'm sure. Claudia was also a member of the German Council of Economic Experts. Soledad Núñez Ramos is a member of the Governing Council and Executive Commission at the Bank of Spain. Previously, she was the Director General of Economic Policy in the Office of Economic Advisor of the Prime Minister of Spain, as well as General Director of the Treasury and Financial Policy. Soledad has also been an Associate Professor at Complutense University of Madrid and IE University. And finally, Victoria Saporta, who is joining us today on video conference, is the Executive Director of the Prudential Policy Directorate at the Bank of England. She has held a number of positions in prudential policy, financial stability, and monetary analysis in her career spanning 20 years at the Bank of England. Vicky was at the heart of the macroprudential and microprudential policy reforms undertaken by the bank after the global financial crisis. So please join me in welcoming our panelists. So to get started, what we're going to do is we'll go through 3 questions. And the setup will have each of the panelists spending a few minutes to talk about the questions, have opportunities as well to respond to comments previous panelists have made during their time. And then we'll be keeping our eye on the time and open questions as well up to the floor. So the first question, the COVID-19 pandemic has affected all workers in a variety of sectors, and especially with profound impacts on women and other underrepresented groups in the workforce. What are the impacts of new ways of working on women and underrepresented groups? What can be done to alleviate the challenges they face? So I'm going to start off using the same order that I introduced people in, but I will rotate the order across the different questions. So with that, Lisa, I'll go to you first. And just push. Oh, I just reread the question, so yeah.
Thank you so much, Claudia, and thank you for the invitation to be here today. I want to start with the initial impacts on various groups in the economy. Certainly, we know that everyone was affected, but certain groups were disproportionately affected. If you'll recall, with respect to the employment to population ratio, different groups were affected more severely in that way. So women, African Americans, Hispanics, and workers in lower skilled jobs were more affected, mainly because they're disproportionately represented in jobs that are public-facing, that require in-person interaction. Also, workers with lower levels of education were affected severely by the initial impact of the pandemic. And again, this happened to be the group that would be concentrated in the service sector that was in person. Many of those jobs that are difficult to do remotely, African Americans and women were likely to be employed in those areas as well. But now, payroll employment is up. It has exceeded the February 2020 level, but as high as it has been, the recovery has been, it is lower than it would have been had there been no pandemic. So not only do we get this distribution of effects, we don't get back to where this is, where it would have been had there been no pandemic. And despite the recovery, we know that groups, certain groups, have long-standing disparities. There are long-standing disparities that remain. We also know, for example, that while it varies from month to month, the black unemployment rate is roughly twice that of the white unemployment rate. Did you want me to go through all of the many questions, or should I?
No, just the first question.
Okay,
so
just
some,
okay.
How it's affected workers in different areas and
Right.
particular impacts, and especially if there are suggestions for how we can actually alleviate some of the challenges. I think that's particularly of interest to the audience. That's a tough one.
No, it is a tough one. So I was wondering which ones I could skip. So I won't skip that one. I won't skip that one. monetary policy, as we all know here, is a blunt instrument. So we have to be careful how this is wielded. Certainly, right now, inflation is much too high. So the focus for the Federal Reserve is on addressing inflation. And we want a sustainably strong labor market. So we want to make sure that this is addressed. There are others who may be able, this longstanding issue that I mentioned, these disparities that I mentioned, there are other policymakers who would be more appropriate in addressing those. Elected officials, for example, and businesses. My research on patent teams that I was talking with people at breakfast this morning about shows that women and, by extension, other diverse groups make patent teams more productive. And there's a metaphor for the rest of the economy. So in that sense, it doesn't have to be a Federal Reserve intervention. It doesn't necessarily have to be policymakers' intervention, but it can be intervention by businesses and by other groups to bring about greater participation in the economy. So I'll stop there.
So we'll turn now to Claudia.
Yeah, thank you very much, Sharon. It's good to be here. So thanks also to the Bank of Canada, the governor, and for the entire team for inviting me. So when preparing for this panel, I thought, why is it important? Why is the issue of diversity actually important and fair participation in the labor market? I think that in and of itself, I think it's an important goal, and it would be hard to object that this is crucially important. But the point I would like to make here is that it is also important for us as central banks. So if we are very, just thinking about our own mandates and what we have to accomplish in these days, I think it's important that we have diversity of thought around the table. So I would, in the context of Germany, I think what's on people's mind right now is of course, the COVID situation and what happens. But to some extent, we're post-COVID, but not necessarily in a much better world, because now we think a lot about what the energy transition, the energy price shock means for the German economy, how we're going to deal with this, the potential of deglobalization, how is it going to affect German firms and households. And all these are issues that also central banks have to deal with. So we're really, I think, at the beginning of a period of structural change, and we need all people around the table to really help us thinking about these issues. So this is, I'm not sure whether the patent teams are a very good example, but I think this is a small example how important it is, like Lisa just said, to have all people around the table. So in that sense, I'm really grateful to be here. Coming to the to your question, so what can we learn from the COVID experience? I would say my most important learning term or learning experience is the importance of resilience. Of course, as central banks, and I'm personally in charge of the financial stability mandate of the Bundesbank, we continuously talk about resilience in the financial system. But I think here we've seen how important resilience is at the individual level, but also at the level of the macroeconomy. So very much what we've seen during the pandemic in Germany is similar to what Lisa just mentioned. It was the groups that sometimes had to struggle more on the labor market were affected the most. Those who can't just stay at home, work from their nice homes, but have to go out and deal with clients day to day. So those people have been affected the most. We know from surveys that working from home has been used by the higher skilled, the better earning households. Families generally appreciated the flexibility that they got, but then when you ask within the families, it was often the mothers who reported that their life satisfaction has declined because they had to deal and struggle with many things at the same time. So we do see differences in terms of ability to adjust at the individual level. We also see that with regard to financial resilience. So I'll come to the fiscal policy response in Germany in a minute. But just when you look at survey evidence, when you ask households, how did you deal with the effects of the pandemic, it's again the the lower income households, those with lower levels of wealth, that found it more difficult to deal also with the financial hardships of the pandemic. Having said that, the German government did a lot to mitigate the impact of the shock on firms and households. So we had, that's an interesting stylized fact actually from the last 2 recessions in Germany. Typically, you would expect that corporate insolvencies increase during a recession. That would be the normal pattern. In the past 2 recessions in Germany, corporate insolvencies have actually declined, and that is, of course, also good for the workers because they're not laid off, and sometimes or very often the shock was just a temporary shock, and so they could stay on their job. So it's a large groups of households, and these are again the lower skilled, lower income people who were protected either through fiscal measure or short time work, which is an instrument which is the flexibility gives flexibility at the firm level to actually keep workers on the payroll. I think in that regard, the US experience is very different because you had a huge increase in unemployment, and that didn't happen in Germany. So the German labor market, much paralleling what we've seen for the corporate insolvencies, was very stable throughout the pandemic and is still very stable, very robust, even though we're facing a massive energy price shock. So in terms of and I mean implicitly in what I'm saying is, of course, that the tools central banks have in their hands are very limited. So here it comes really to financial resilience or resilience more generally at the household level, and then also labor market policies play an important role. And our thinking, as I said earlier, is now already a bit about what's next. So not so much about what exactly can we learn from COVID, because the shock we are currently facing is a very different one. It's likely that we're going to see more corporate insolvencies, and so we need to, I think, maintain and keep those elements of resilience, greater flexibility, also going into the next phase we're facing.
Thank you. I'll pass it across now to Soledad.
Okay. I am very thank you for inviting me and be with this such a top women. I am really proud of it, and to be here and answering more in more detail your question of post-COVID. I mean, I think that pandemic accelerated two trends that were before there, but the pandemic has accelerated them, and that affects women. One is teleworking, and I think the Americans use more remote work, but we Europeans, I think we use teleworking, so I will use the teleworking word. And the second one is digitalization of the economy, and both things may have effect on gender and diversity for the labor market. And talking about teleworking, I think it has advantages and disadvantages. I mean, and right now, I have here some figures, but right now, in Europe, according to Eurofund, 21% of men and 25% of women are teleworking at least some time per week. And for the financial sector, this figure is much higher. It's around 50%. As I said, it has advantages and disadvantages. Advantages is just you have organized better your life. You have more time. It facilitates childcare and elder care, and it may give the opportunity to share more the unpaid work with your partner. This is in theory. Has not to be true, and there is a lot of evidence that this is not the case. And the drawbacks is that, well, at the end, you may end up working more hours and at the same time having more unpaid work. So at the end, you have a harder life. It's difficult many times and for many women to separate work life from family life. And this is one of the drawbacks. The other one is isolation, and it also may have effects on promotion. Not being physically present may difficult promotion for women, and it will mean also less networking. And networking, we know, is important for promotion. And networking is already more difficult for women. So if now they are in distance work, it can be even worse. Anyway, it seems like teleworking is very popular, and there is a survey that is in Canada. I mean, the labor ministers, I think the labor force survey made a question about this, and 80% of people that worked teleworking in the pandemic wants to keep teleworking at least one time per week now. So, and for instance, in the Bank of Spain, now we have introduced the teleworking policy, and 80% of the staff has the right to work, maybe not so much, but it's 2 days per week. And the people that have accepted that is 97% of men, 95% of women. Women less, even though usually it's more popular among men. In this time, it was more popular for men than for women. And I think what can we do? Well, of course, I think it's really important to introduce a policy of the right to disconnect, which is, I think, is essential, and also to ensure that teleworking does not discriminate against promotion, and do mentoring, special mentoring for these kinds of, for people that is teleworking. Of course, the best way is also to have a hybrid model, no? Not all the time teleworking, or not all the time on site. On digitalization, I think this is a big challenge for gender. I mean, it gives big opportunities for women, but also it has a big challenges. And this is because there is big gaps. We have first the gender digital skills gap. And with some figures, let me, because I don't remember them, is, for instance, I'm talking about skills. A survey that was made by I think that it was by UNESCO. 25%, the women are 25% less likely to use basic Excel, and 75% less likely to use computer programs. But we don't have that only that digital gap. We also have a digital education gap. The share of women in STEM fields, or ICT, STEM, I mean, is science, technology, engineering, math, and ICT graduate is really low compared with other studies. Globally, the share of women on ICT studies was in 1920, 29%, and in STEM fields, 36%, while, for instance, in health and care study was 69%. And the reason seems more related with stereotypes, the kind of thing that math are for men, than capabilities, because also UNESCO made a survey on teenager achievements, and that survey showed that girls perform slightly better, slightly more or less equal than boys on generic science literacy tests in most nations, not only. And also here in this educational digital gap, we observe the so-called educational gender equality paradox, by which those countries with a higher gender equality score, like, for instance, Nordic countries, are paradoxically where this percentage of women in STEM or ICT studies is lower, and is much lower than, for instance, than India or Indonesia and so on. So here I think we have a very important gap, and then we have, of course, the digital gap in jobs. Globally, women hold only 20% of digital jobs. Globally, only 6% of mobile applications and software developers are women. The STEM and digital gaps are also reflected in artificial intelligence jobs. Only 20% of artificial intelligence jobs are occupied by women, according to Bruegel, a study made by Bruegel. This artificial intelligence gap is presented in all industries, and for instance, in finance, women hold only 20% of artificial intelligence jobs, in software and IT services 19%, and in health 25%, and in education 25%. The gap is, of course, higher for leadership positions. According to UNESCO, women hold just 5% of leadership positions in artificial intelligence jobs. And for instance, a big corporation like Google, Google has a 31% of workers are female, but in leadership positions, there are only 25%. And so there is a gap yet. And what happens, that digitalization means that some jobs are going to be destroyed, some jobs are going to be created, and some jobs are going to be transformed. And then with these gaps, the problem is that we have difficulties, women have difficulty in two of them, for the new jobs and for the reskilled ones. I mean, the ones that you need to reskill. And in the financial service sector, for instance, the lack of women in technology is becoming an important challenge to address. As the industry digitalizes in the future, many of the roles with the greatest impact on the industry and on customers will be digital. If women are not reskilled, there will be a wider gap in the coming years, and mostly in the influential positions. And also, in the financial sector, with digitalization, many of the frontline roles traditional held by women, like in branches, I mean, bank branches and so on, and call centers, are likely to be disappeared. So what to do there? Well, probably as with central banks, cannot do much because the gap starts at the university. But yes, probably we can do things to encourage, I mean, that this thing of the stereotypes that math is not only for men, math is also for women. And also to reskill, I mean, to have special policies to reskill workers, I mean, our staff, our female staff in this kind of digitalization areas. And I think that I have talked more than 5 minutes, no? Sorry.
All right, we're going to now go to our virtual participant, Victoria Saporta in, well, I'm assuming she's calling in from England, at the Bank of England. I think you're so she's not frozen online, she's frozen on our screen, but I'm not hearing her, her audio coming through. So just a moment, we'll have our tech people check. While we're having that check, I just pulled together a few of the themes that I've been hearing so far. I think one thing that's come out is, some information on the diversity and the importance of diversity of thought as we come forward, and how, in the current world where we're faced with so many challenges and coming off of a pandemic, that it becomes even more important to bring new ideas and innovation to the table. And so having that diversity of opinions coming forward is something that could have huge payoffs right now. One of the things that we learned through the pandemic that was important was the resilience of individuals and the ability of people to adapt. Every time we had a wave, we would adjust our expectations, recognizing people had learned in the past how to do things, and we would still end up underestimating how strong the economy would do. So building learning in, we were still underestimating, which just, again, shows the resilience of the people through this. We've learned that there are some trends out there that were accelerated through the pandemic. Teleworking and digitalization, which had huge benefits from the point of view.
Welcome to Poly Real Connect service.
So he had huge benefits from the point of view of flexibility, reduced time by teleworking, et cetera. But it also opens up some new interesting challenges, which is with this acceleration, are the gaps that we see across different groups in terms of their skills and competencies going to be changing? Are we going to have to adjust to new types of gaps? So I think we now have Victoria back, so I will pass it across to her.
Yes, hello. Can you hear me now?
Yes, we can. Thank you.
So there's a, I'm afraid there's a bit of an echo.
Nico.
Maybe people need to mute. I'll try again. No, there's an echo. I'm sorry. The organizers need to do something. I think the auditorium needs to mute. Okay, there's no echo now, but can people hear me? If people are actually quite helpfully sending messages in the chat box. Excellent. I cannot see the auditorium, but hopefully that matters less. Well, anyway, thank you, Sharon, for this, and very interesting comments by all the impressive women on the panel. I mean, a lot has been said already. I mean, the evidence from the research during the pandemic is pretty clear that it was women and the ethnic minorities, Hispanics, Blacks, and people that were doing more manual jobs and had to go to be physically in work that got impacted more. So the important question is, now we are outside, well, we are well, obviously COVID hasn't gone away, but we're outside the period of lockdowns, and the economy has recovered, although it has recovered in different ways and through different challenges in different countries. And of course, now we're facing, for example, in the UK, the prospect of a recession, but also elsewhere. How has this experience impacted on diversity? There is some evidence from labor market data that some of the impacts that we saw during the pandemic have unwound, but there is also evidence that for example, in the UK, for example, we have a drop in labor market participation. And there is some evidence that that might be impacting people that have to care for others, that tend to be women. It's not only women, but it's disproportionately women. And also women are more likely to drop out than men. So the evidence post-pandemic is still a bit mixed, but it does suggest that there could well be a hangover that will impact women in particular more. And then, of course, there could be long-term effects that might be hidden. For example, there is evidence that more girls dropped out than boys as a result of lockdowns, when we have evidence of higher dropout rates from schools, and that has affected girls more than boys. And equally, mental health issues that have tended to affect also girls more than boys in certain areas, and that could have a long-term impact on women's participation and women's success in the long run. Now, what do we do about it? I mean, there used to be pre-pandemic a well-documented working from home penalty. So there is, which a lot of people know what it is, but it's basically lower performance ratings for those individuals that tended to work from home rather than those that showed up in the office. Now, this even pre-pandemic tended to disproportionately affect women, because they tended to value the flexibility of working from home, usually related to caring responsibilities, more. Now, it is very important, I think, for businesses to have a very structured approach on the ways of working, and to try to mitigate any working from home penalties so that diversity is not affected. So that's one thing that we could all do. I mean, the second thing is, why does diversity, Claudia touched upon it, why does diversity matter for people like central bankers and financial regulators and people that care about financial stability? I mean, the key reason is, apart from the fact that is that we need to represent the societies that we serve, and we need to represent the societies we serve because we need to be places to that every part of our societies, of our countries, can feel that they can have a place in, and that we're not seen as some sort of remote elite institution that makes pronouncements on interest rates and QEs and capital adequacy requirements without representing the societies we're actually underlying serve. But moreover, we need, and when I say we and the we need to show to people that come and join us, that come from backgrounds that traditionally have not joined us, that there is a way to reach the top, to be in leadership positions. I've been in many diversity and equality panels that included people that told senior people that told their personal stories, and the one personal story that comes out, I don't know if the women in the panel will recognize it, is the lack of role models when you were driving to the top. If you don't see people that look like you or might have your behaviors into the top, you need to change your behavior often. And it's not very easy to change your behavior while focusing on actually your actual substance of the performance. A lot of women, for example, are known to have tried to behave a bit like men in order to reach the top. So I think that we need to find ways to facilitate diversity in leadership positions in central banks, but also in areas which are underrepresented. Digital industry, as Soledad says, is really a lot of underrepresentation of women, including in boards, but also in finance more generally. Now, how do you do that? That is a big question. And that opens up the very difficult topic of targets. But I will leave it to that. Thanks.
Thank you. I think you actually did a very good job of transitioning to the next question. So I'm just going to flow into that one. The next question is more focused on the economics and finance professions. We know that economics and finance professions, and by consequence, central banks as well, have a diversity and inclusion problem. In your opinion, what strategies prove most effective in addressing it? What can central banks in particular do? So I said I was going to switch things up, so I will start with Claudia this time around.
Okay, thank you very much. We also, in the Bundesbank, have a leadership gap defined in the following way. I think it's following up a bit on Soledad's numbers. So we have about 50% of women, so it's a 50-50 representation in our bank. And we're struggling hard to get the leadership share to 1/3. Now we are, depending on whether you look at the headquarters or the regional level, we are at 33, 35%. So there's, however you count it, there's kind of a 10% leadership gap. Why is that? I mean, it's to some extent obviously reflecting what's happening in the economics profession, economics and finance. So when you look at universities, you would see a very similar distribution. So I fully agree that we really have to share at a level where we integrate the entire society, where we explain that finance and economics is not just for those who want to earn a lot of money in the end, but like Victoria said, this is really about how society works. We have to explain why it's important for society that these issues, financial regulation, stable financial sector, why that is important. But this is a hard sell, so maybe that would be for another panel how we get there. So to some extent, it's reflecting what we're seeing in the field of economics and finance. But then we're not just hiring economists. So actually most of the people working in the bank come from other areas and they have other backgrounds and they do other things. So our economists are a relatively small share of our employees. So why is it then that we have this gap? And I should say that it's relatively persistent. So we're doing a lot of things. I actually also think that some kind of target, however you want to call it, target quota, so some kind of quantitative indicator is very important, because you need arguments also to discuss with leadership how to improve the balance. And again, it's not an end in itself, but I think it's important for us to function as in institutions and to deliver to society, like we've just said. So we use a range of tools. We have, of course, mentoring programs. We have regular, so our the heads of our business areas regularly have to report to the board, and it's not a binding quota, but actually there's also some legal constraints coming from federal legislation, because we're a public sector institution, so we also have to meet certain targets, and we have regular conversations with our senior management on this. But I think in the end, it's up to us, it's up to the entire organization to recognize that this issue is important. And I would like to give a specific example referring to what Soledad said and the what was it called, the working from home penalty. So I'm strongly convinced that the flexibility we have now, that we've all learned how to work from home, that's benefiting us a lot. So it's benefiting everybody who has to deal with family issues of different sorts, and just this flexibility is incredibly important, and also the opportunity to actually allow much more people to dial in and to listen to what we discuss in meetings. But it comes with this potential cost, that the teams are becoming more fragmented, that there's not this informal conversations. And I think we have to be very much aware as managers, as leaders, that this is an issue, and explain to people why it is an issue. So I mean, I'm just imagining these conversations at home. So why do you have to go to the office? You can just do it from home. You can just work from home. It's just so much easier for all of us. And I think we have to give these examples. We have to maybe also use the evidence that Vicky has mentioned, and explain why it's important that people come in and find ways of how to organize this. And then maybe my last remark here. We are such analytical organizations. I mean, we do with monetary policy, we do with all the academic rigor, and we have models and tools. But here, when we talk about these things, I think we do use relatively little evidence from within the organization and also from outside of the organization to actually make our point. So I think we could do much more to also bring our data together and see what works in a specific institution, and how we can adapt the tools that are around to increase diversity, to use them for our day-to-day HR management. Of course, then there's also a big qualitative part, but I think we can use evidence, quantitative evidence, much more to actually improve what we're doing.
Thank you very much. I'm going to go back to Vicky now.
Thanks very much, Sharon. I mean, basically, our situation is not at all dissimilar to what Claudia said. We have a leadership gap. I mean, the pipeline is looking equitable in terms of gender, and also in terms of ethnic minorities. The leadership gap in terms of gender is getting smaller, but we have an issue with ethnic minorities. And at the very, very top in policy committees, there's still, which are actually appointed by the government rather than by the central bank board, there's still a sort of gender gap and a very large ethnicity gap. So it's at the senior roles where we're actually seeing it. We do publish targets of how we are going to try and we sort of assess ourselves against them. And their targets also that go down to individual kind of divisions within the central bank. And now actually, people's pay, including my pay, my bonus, will depend on diversity targets. So there is a direct link now into pay and meeting diversity targets. The starting point where you are starting, because certain areas within the central bank are less diverse than others. You wouldn't be surprised. It reflects the overall economy. So tech, the very technical areas, data science, etc., less diverse than, say, central services within the central bank. So you rebase and you keep on sort of trying. So this is the first year we are actually going to run this. And then we can check how it has changed incentives. But and also every manager needs to be assessed against the diversity and equity inclusion objective, performance objective. So that's the way operationally we're trying to do it within the Bank of England. There is a broader debate with our regulator. We regulate banks and insurance companies and CCPs and payment systems. With our regulator objective, what we should do in given that there is a clear case for diversity of thought in the boards of the institutions that we regulate, what should our diversity policy be there as regulators? And earlier this year, we issued a discussion paper on that front, and we have gathered views. And there are more regulators around the world that are trying to do things like that. So that's kind of where we stand at the moment. Thanks.
Thank you. Lisa.
A critical step that was taken by the American Economic Association and the Canadian Economic Association was to establish the fact. So they both executed climate surveys for us to understand what was going on in the economics profession. And I think the American Finance Association did something similar, but I'll speak to the AEA and CEA climate surveys. I think that the results shocked many of us, that sexual misconduct, harassment, racial harassment, all of this was much more widespread than we thought. And we didn't have the data before. We'd never done a climate survey in the 100 or so years of the American Economic Association. I'm one of the co-authors of that report, so I remember the shock that we all felt. So what happened beyond shock? So we put the data on the table. I think there are two examples that I'd like to bring up of what's happened since. We have on the American Economic Association website best practices. And I think that it would have come as a shock to many in previous generations that the American Economic Association would condone such a move, but they turn out to be very helpful. Some related to hiring, for example, putting in place better processes to hire better, more inclusive faculty. And another best practice has to do with teaching economics. One thing that we know about teaching economics is that textbooks often refer to what macro models typically referred to in the 70s and 80s, a representative agent who didn't look like any of the students who were taking Econ 101. right? So you may have heard Betsy Stevenson and Justin Wolfers talk about creating their textbook that has more inclusive examples. I used to use, I keep talking like I'm actually still at Michigan State. I use Paul Krugman's and Robin Wells' book, and without them talking about it, they have very diverse examples with different genders, with different ethnicities and races included in their examples. And this is what Victoria was talking about, alluding to, having these role models. They may not seem like role models, but if you're thinking about participation in the economy, if you don't see yourself, you think about being excluded. This doesn't concern me. This concerns somebody else. So those are concrete best practices that have come to the fore. There's some other outcomes that we have yet to see. Well, actually, let me mention one that did happen. We stopped interviewing, for the most part, in hotel rooms. It was a standard feature of interviews for the American Economic Association for us to be interviewed while sitting on a bed in a hotel room. And that seemed not to be unusual to us. It seemed to be unusual to everybody else we told this. Right. But that changed fairly quickly. This was a memo from graduate students, initiated by graduate students in the economics profession. And I'm not going to say it changed overnight, but it really did change very quickly. And it needed to. I mean, it was just embarrassing to articulate that we had been doing this for many years and that we hadn't necessarily questioned it, and we considered it the way it was. So I think the survey and activities that followed were good in helping us imagine what could be different, and not thinking that we need diversity of thought, we need diversity of lived experience. Some others, they come from other fields where this was absolutely not acceptable. So I think we need not just thought, but we need different lived experience and the diversity that we have. I think that there are some things that are remaining for us to do. There are many suggestions that come to the fore from the survey. I remain concerned about online harassment. Online is where a lot of our research is shared, and it's increasingly shared that way. Those of you on Twitter or there are other platforms, and this is something that should be addressed and should be addressed readily, and it doesn't take that much. And I'd also echo Victoria in saying that it takes everybody, not just the leadership of an organization, whether we're talking about a department or a division, it takes everybody in the organization crowding around this result. And again, I mentioned my research. I didn't start out studying the diversity of patent teams. What I noticed was that the patent teams that were most productive had women on them. It wasn't that I was looking for that. So what I'm suggesting is not something that says diversity is good for its own sake. It's you're leaving money on the table if you are not implementing these diverse policies. So you're not a good steward. If you're a manager, you're not being a good steward of the human resources of your institution if you're not taking advantage of everyone who is there and the lived experiences of those who are there, the diversity of thought of people who are there. So I'll leave it there for now.
Thank you. Soledad.
Well, I think that, to tell the truth, we have improved in the financial sector and in central banks in terms of gender. And one of the indicators that we have improved is, I think that we don't have to talk anymore about that. I mean, there is a general acceptance that gender diversity and diversity and inclusion in general is not a matter just of corporate social responsibility. It's a matter of, it's an economic issue, and as you just said, Lisa, is something of, it's a matter of no letting money on the table or missing talent. And I think that this is a general acceptation of that. And this is because we have improved. So it's an indicator. In terms of figures, too, I'm gonna tell you some figures referred to Europe. I mean, economic students at the graduate level and bachelor level, 52%. Economic students at master level, 51%. This is the share of women. Economic students at doctoral level, 39%. Employees in the financial sector, 52%. So we have the pool. It's not like in the digital case. Here we have the pool. So if at the end we don't have the same thing at the top, it's because something is wrong and something happens. I'm going ahead. Board members, we have improved a lot in the financial sector. Right now, it's 30 in Europe, 33% of listed companies. I am referring only to listed companies, compared to the 23% back in 2015. Executive board members, 22%. Yeah, this is different. Before it was 18%. So a little improvement, but not so much as in the board. And the board there has been a lot of improvement at the board level because there has been policies of quotas, sometimes mandatory, sometimes soft quotas, and then things there have improved, but not so much as you go down. CEOs, how many CEOs are women in the financial sector listed companies? 12%. Compared to 7% in 2015. C-suite positions, 17%. Senior leadership positions, 21.7%. Managers, mid-managers, 27.7%. So there is something there. Of course, I mean, from 51 to 27, there is something there. I think, I mean, if we talk about central banks, is about the same, as Claudia has said. I mean, I think we have all the same problem. I mean, in Europe, set of women governors, 0%. 0. 27 central banks, 0. Deputy governors is a little better, it's almost 31. And board members in general, 29%. As you said, they are elected by sometimes by the government or the parliament. So it's not a matter of the own central bank policy. And if we go down the scale, we have the same that in the private sector. For instance, in the Bank of Spain, we have 14% of DGs, and we are very good in the Bank of Spain. We have, relative to other central banks, we have really good numbers. 40% of deputy DGs, in the level 3, 30%, in the level 4, 40%, in the level 5, 35%, in the level 6, 45%. Even in the level 6, it's not, I mean, and we have good numbers. And there is a heterogeneity in these figures because it depends on the department. I mean, for instance, legal department is overrepresented. Women are overrepresented. All the managers are women. So there is no room for complacency. Complacency? Well, more or less. And what to do? Well, I think is, of course, you need a plan. You need to make a plan. But before that, in order to make a good plan, you have to do research. You have to look what is happening in your institution. And not just general numbers. You have to do research, real granular research. And once you find where the gaps are, you have to find the reasons. I think that in this practice, the work by Ospido, Leven, and Delamo, who is here, is a really good practice to see what happens, why women do not go to promotion. And it's research, real research. So you need that. What else do you need? Of course, mentoring programs, blah, blah, introduce flexibility, consolidation measures. But in this thing, I think that there is something that is crucial, which is that you have to avoid, and this is difficult, to avoid and to ensure and that to make the staff safe that there is no maternity or penalty when you get the flexibility that they give you, and if you are a woman, make sure that this woman do not feel like the fear for penalty. And one way to do that is that to try that men do the same. Because the problem is that men do not take this flexibility. I have here some figures, and I think that in the Bank of Spain, again, we are kind of good. I mean, it's for reduction of hours. 87.6% were women and 12% men. In terms of flexibility of hours, not reduction, but flexibility, the figures are better. 40% men, 60% women. So, but this tells you that men gets this much later. So, in order to avoid this penalty, to ensure the staff that you don't have that penalty, I don't know how to do that, but it's to try that men also take this kind of facilities. Probably they don't take it because they have the fear that then they will be penalized, and then the managers have to make sure that this is not the case and to make the staff feel like this is not the case. I think that's a very important piece of the policy to get women more brave to promote. To apply for promotions and so on. And of course, once you have the plan, you have to, I think that is something also crucial, that everybody in the institution has to be involved, and the board, of course, has to be informed, and then you have to do like an assessment periodically to see if the policies are working or not working. And again, this has to be made not only in general terms, but at the granular level. And I think I will stop here.
Thank you. I know Claudia had one quick rejoinder she wanted to add.
Yeah, no, just a quick point strengthening what Soledad said. I think what we really need to do is do very granular work, look at our data to the extent we can, for data protection issues, to see what the specifics are and issues are in our organization, whether it's just, quote unquote, the gender issue. That's relatively easy to observe, and whether there's also other issues. And we also have to be aware of the unintended side effects. So promoting women a lot can also have implications for the men who do the family work. So I think we all recall the stories, maybe years ago it has improved, but where men want to do the family work and they are really being told by their bosses, well, if you do this, then that's the end of your career. So I've heard those stories. So we have to make sure to understand what the issues in our organization are, because they can be very different when we talk about diversity more generally.
Lisa, did I see that you had wanted to add something there, or?
I would quickly, in addition to knowing what's going on in our institutions, we need to know what's going on in our fields. If we are primarily hiring macroeconomists, we need to know what's going on in the field of macroeconomics. Why are women missing? We need to ask that question. What is happening? What is special about macroeconomics and finance such that women and underrepresented minorities are not there? So I think doing the cuts, diving deep into the data, I think would be really important.
As a female central banker, it was very common for me to be one of single-digit female participants in conferences that would have, 100 or more people at them. So, yeah, we have some serious challenges. I think what I would take away from this session in terms of one important theme, and this is really what came out at the end, is, we are central bankers. We're used to making evidence-based decisions in places like monetary policy and in regulation for those that do that. And so we just need to do the same sort of thing more broadly in other practices. We need to be collecting data, analyzing data, and that will help us achieve better outcomes. So I'm going to move to the last panel. I'm mindful of the time. We are running a little behind, and we're trying to end by 10:25. So with that in mind, I'm going to ask people to maybe shave a little bit some of their comments on this last area. And unfortunately, I am guessing we will not have time for audience participation, so people can hopefully at lunch and that interact. So the last question is very different. The recovery from the pandemic has been followed by currently elevated inflation, which affects everyone negatively, but with the burden of inflation being borne disproportionately by women and underrepresented groups. What are the ways inflation puts different pressures on workers and families depending on where they live, what they earn, and how they spend? How could or should central banks and policymakers communicate the unequal impacts of inflation in a way that enhances trust? And Vicky, I'm going to go to you first. You put up with the delay at the beginning, so I'll let you take it away.
Yes, thanks, Sharon. I'll try to be brief, given the time. I mean, it's quite clear that I mean, I guess the three channels that inflation puts has distributional different effects on heterogeneous households. Is the Fisher effect, which basically gives advantages to people with to people that lend rather than people that borrows. It's kind of the straightforward income effect with real incomes falling, and then it's the relative consumption effect for people that rely more on the sort of core goods that our inflation index captures, and particularly given the type of inflation that most of us are experiencing on food and energy prices. Now, my reading of the data is of the literature is that it's unclear. It seems to be, which is quite interesting, that different countries produce different results on which effect dominates. In the UK, for example, there's quite a lot of evidence that poorer households are experiencing higher inflation rates. So the relative consumption effect appears to be dominating. I mean, I recently read a paper that suggested that in Spain, for example, the other two effects dominated the relative consumption effect, which is kind of interesting on what precisely, what is the reasons, what is the underlying heterogeneity. But there is no question that in our countries there will be distributional effects. It does pose a big communication challenge with central banks. I mean, in the Bank of England, a mandate is primarily price stability, and the government's economic policy is very much a secondary mandate. We don't have a direct distributional role. I think that's pretty common amongst central banks. Yet, we have to be able to analyze and acknowledge while focusing, I think, our monetary policies and our policies on our mandates. This is the primary thing. We have to acknowledge and provide analysis and research and communicate the impact that that might have on different households, in order to be able to show that we have a broader understanding for this, but differentiate what we can do policy-wise from what is the responsibility of others. But we should not be, we should not pretend that there are no impacts of the policies that we have. I mean, in the financial stability domain, of course, heterogeneity plays a huge role in terms of the actual resilience. So it has been shown that kind of distributional outcomes matter more for resilience. So there, I think we should use this distributional analysis that comes from inflation and directly incorporated in our financial stability reports and our financial stability analysis. But ultimately, we have to stick to our mandate and stick on that, but recognize the impacts of our policies more broadly. Thanks.
Thank you. Lisa?
So I'll skip right to the chase. Victoria mentioned a few points that I was also going to make. I'll just echo the paper that was presented yesterday and the work of Michael Weber and Yuri Gorodnichenko and Olivier Kodmia, that shows we have some evidence that inflation varies across the distribution. Lower income people, as Victoria was saying, more affected. This is something that the board staff have also found. Less educated people, African-American households. And this works in a number of different ways, as Victoria was saying. The lack of savings for lower income people, and having less of a buffer to be able to weather such storms. So I think that these distributional analyses are also extremely important. Again, monetary policy is a blunt instrument, but fighting inflation will hopefully provide a sustainable economy for everybody. So the falling real incomes among lower income folks and the inflation that they face, given their budget sets and given what's in the composition of those budget sets with food and energy dominating, this is something that would be beneficial to all. But we can't, I think, ignore that there are distributional effects that we've already found. I'll just leave it there. Thank you.
Thank you. Claudia?
Yeah, thank you. When I first read the question, so what can we do concerning elevated inflation? What communication tools can we use? What messages can we send? I thought, well, I mean, and others have explained the hardships that fall in particular on the financially vulnerable. I thought that, well, there's little we can do in terms of communication rather than just saying this is hard. No, I mean, it's not, communication is not going to improve that. So I think where I see the role. I mean, first of all, let me say what is also one aspect of a differential impact and distributional impact in Germany, and that's differences between East Germany and West Germany, because we have lower income still in East Germany, so the real income effect is more severe, and we have much lower levels of financial wealth. So the buffers people have are much weaker in East Germany. So that, and then I think, but you've all said it. I mean, the most important tool we have as central banks to ensure that credibly inflation expectations are anchored, that inflation comes down, and use our instruments. I should say, in the case of Germany, we fortunately don't have that many households. I think that's different from the UK, where rising interest rates immediately lead to higher mortgage rates, because most mortgages are fixed over like a 10-year period or so. So and it's usually the little bit wealthier households that take out mortgages. So that's not that much of an issue. I think Spain is also different in that regard. So anchoring expectations ensure that we fulfill our mandate. I think that's the most important policy. I think communication is to some extent secondary when it comes to these hardships. But I think we have an important role to play, I think, in explaining what's happening in the macroeconomy. So as I said, I mean, Germany, I think different from Canada, is hit by massive terms of trade shock, like other European countries as well. So we have to make sure that we deal with the energy situation. So we have to maintain incentives to invest into energy supply, do energy savings, and all these are policies that also have to do in the end with addressing the inflation issue. And here we're actually doing a lot in terms of communication, trying to explain what is happening. It's interesting to see, at least that's my observation, that conversation in Germany is very serious, very, I mean, of course, people are very much concerned about inflation, but they also try to understand what are the sources, what can we do, what policies are needed. So that's, I think, the type of communication where we have a critical role to play, because there's few institutions in a country that can do this macro conversation and macro explanation of what is happening.
Thank you. And Soledad.
I very much agree with what has been said. I think, I mean, for instance, in Spain, it's also clear that inflation affects different households. And we as central banks, I think that the first thing we have to do is to study this. I mean, to do research on what is the case. For instance, in the Bank of Spain, now there is a study that is not yet published, it's not published yet, that use individual data of the household spending survey And also, the conclusion, there is a preliminary results, but the conclusion is that low income have higher inflation than that households in the top quartile, no? Or quintile or decile or whatever you want. It's also another result is that households where the head is older than 60 years also suffer more inflation. This is another important result that is not the same for young people than for old people. Also for households with more members is also the case. For female head, the results are not so clear, but once you take into account that they are lower income, less number of people, that they live in a town, in a city instead of in a village and so on, then you also get the result that female suffer also more. Household with a female head suffer more inflation, and I think you have to work and to research on that and to communicate it and to explain. And maybe this part of the explanation is not so difficult, because you are going to say at the end that you have, that is good, an institution like a central bank that has to fight against inflation and that tries to control inflation, because inflation has very bad effects on low-income economies, for instance. There is another part that is more difficult, because then it's the part for financial stability. Vicky said that then you have the thing of the increased interest rates. In the last report of the financial stability of the Bank of España that was published last week, they calculated, this is an exercise, it's not so much as the study that I mentioned before. They calculate how much spending means the increase in inflation and also the calculation of if the interest rates increase 300 basis points. And the result is that, of course, that low-income families, the spending for non-durable goods increases 10% of their income, compared with 4% for rich people. And in terms of spending in interest rate burden, is 4 against 2%. So this part is more difficult, because you have to explain that they are going to have a more financial pressure, and but you have to communicate that, and then at the end, you are increasing interest rates because you are trying to control inflation, and inflation is bad for low-income people. And also, it's true that it's not our, we just have the inflation goal and target, and not, the economy one is below. It's also there, but it's provided that you fight against inflation. But we have another function, at least in the Bank of Spain, and I think that many central banks do too, that is to advise the government on things to do. And I think in this case, and what you have to advise is that to introduce measures that are targeted for certain parts of the population, like for the vulnerable groups, instead of a general measure that can be inflationary. And I think I stop here because...
Thank you. Yeah, so I'm not sure if other people heard the same thing I did, but I heard a lot of very similar comments in this last panel, which is, our primary mandate is to achieve low, stable, predictable inflation, and that ends up being, of vital importance when you start thinking about the fact that often it's the low end of the income pool and some disadvantaged groups that are disproportionately negatively impacted. But in doing that, we need to be really careful. We need to communicate clearly. The more people understand what is happening in the macroeconomy, how we're interpreting the data we see, why we're doing what we're doing, and at the same time, understanding and recognizing that what we're doing could be and will be very challenging for some groups. But in the end, it's better for all if we can get the low and stable and predictable inflation. So again, as everything else, always scope for more learning, more information coming from data, a lot of experiments through this past COVID period in new data sources, microdata, et cetera, that are only going to prove more valuable, I think, as we move forward. So I'm going to stop it there. This way we will have time to reset the stage before the next session. Thank you very much to all of our panelists. I think we've had a really interesting discussion this morning. I certainly took a lot out of it, and I hope you all have as well. Thank you.
Oh, don't worry. Well, it was for her, but nothing happened. She didn't get
So yeah, without further ado, welcome to the final session of this great conference, this D&I conference, before the closing remarks. So I'm sure I'm speaking on behalf of many of us to say that it's been an immensely insightful event so far, not over yet. And while many of the insights have been pretty sobering, I think we do also see, or starting to see, what can help, what can work, and what maybe works less well. And I would like to thank the Bank of Canada for being such wonderful hosts. It's been really, the hospitality has been incredibly generous and wonderful. So the focus of this last session is around shedding light on the sources of inequality and what can be done to rectify the situation. And the focus of the three papers in particular is on the loan market and what factors play a role in determining successful applications. We are a bit short on time in this session, so we have about 20 minutes per presentation, 10 minutes for the discussion, but only 5 minutes, if that, for the Q&A. So I really, really would ask the presenters to stick to time, and I will have to be very fierce. So without anything else from me, the first paper is presented by Hyung Lee from Boston College, and I think you're online. Floor is yours.
So thank you so much for your introduction. It's my great honor to be here to present my paper, Bank Competition and Entrepreneurial Gaps, Evidence from Bank Deregulation. I'm really sorry I cannot attend the conference in person because I have some teaching works, but I hope in the future I can have some opportunities to attend your conference in person. The motivation is that entrepreneurship is really important because it can boost economic growth by driving job creation and innovation. Despite its benefit, there are still huge gender and racial gaps in entrepreneurship. So for example, if we look at the following figure, we can see women made up 47% of total labor force. However, 20% of business owners or employees, they are female. If we look at their contribution to employment, these gender and racial gaps are even wider. Female entrepreneurs, they create 8% of total jobs, and Black entrepreneurs, they create 1% of total jobs. These gender and racial gaps are quite persistent in contrast to the gradually narrowed gaps in other occupations. So ideally, if we can reduce the gender and racial gaps in entrepreneurship, maybe we can drive economic growth and reduce inequality in entrepreneurship. So given the importance of reducing entrepreneurial gaps, we need to understand the causes of entrepreneurial gaps. Lots of papers find that financial frictions may cause entrepreneurial gaps. For example, Failey and Rob's paper find that the most important factor that determines the success of minority-owned firms is the lack of startup capital. So what kind of startup capital do entrepreneurial firms use? Rob and Robinson, they investigate the capital structure of entrepreneurial firms, and they find that entrepreneurial firms rely heavily on bank loans instead of equity financing. So given the importance of access to bank loans, we still know that minorities and women, they are disadvantaged groups in the lending market, even control for their credit worthiness. They will face high rejection rates, higher borrowing costs because of discrimination in the lending market. So how to solve this problem? Here is one potential solution. Becker's discrimination theory predicts that competition can reduce discrimination in the labor market. If we apply his theory to the financial market, my research question is that, can bank competition narrow entrepreneurial gaps by reducing discrimination in the lending market? The answer is not obvious. On the one hand, competition can increase the cost of discrimination, so it can reduce entrepreneurial gaps. On the other hand, the answer is not necessarily yes, because competition may move banks away from relationship based on lending, which is well suited to overcome asymmetric information problems. And we know that female and minority entrepreneurs rely heavily on relationship based on lending because they suffer from asymmetric information problems. So to solve this problem, we face two challenges. The first one is that we need a direct measure of discrimination free of omitted variable problems. The second challenge is that we need some exogenous shocks to financial market competition. So here are my solutions. As for the first challenge, I plan to use the Consumer Financial Protection Bureau complaint dataset. So Consumer Financial Protection Bureau is a bureau established after the financial crisis. Its main aim is to protect consumers' rights. If you are not satisfied with banking services, you can file a complaint to this bureau. So I use this complaint data set and build a direct measure of discrimination from the narrative information complaints against banks using textual analysis. As for the second challenge, I take advantage of the staggered interstate deregulation law changes and build a state-level bank deregulation index following Rice and Strahan. Specifically, I will use the following two acts, IBBEA and the Dodd-Frank. I will talk about how to build this bank deregulation index later in detail. So let me preview my main results. Let's look at the main result first, bank outcomes. So in this slide, I find that bank deregulation can reduce gaps in the quantity and the quality of banking services. As for quantity of banking services, I find that before deregulation, minority communities, they are underserved by banks. They have lower branch density. However, after deregulation, the branch density in minority communities increases a lot. And also this increased branch density will translate into financial inclusion of minority borrowers. So it means after deregulation, minorities, they are more likely to open bank account in these newly established financial branches. As for quality of banking services, I find that before deregulation, minority communities, they receive low quality banking services measured by the total number of complaints filed to the CFPB. After deregulation, the quality of banking services in minority communities also improves a lot because of the entry of the out-of-state banks because of bank deregulation. The third point is about discrimination. So as I mentioned before, I developed a new measure of discrimination using textual analysis by analyzing the narrative information contained in the complaint filed to the CFPB. So based on this new measurement, I find that deregulation can reduce complaints about discrimination because of intensified competition. So let's move to the second result, entrepreneurship outcomes. So probably because of the increased quantity and quality in the financial system, bank deregulation can reduce entrepreneurial gaps in the following three aspects. In business information, as for business information, I find that in fully deregulated states, the gender and racial gaps can be reduced by 40% and 70% respectively. As for startup capital, minorities and female entrepreneurs, they can raise more skilled business debt and home equity loans after deregulation, which is the main channel of bank deregulation. So also probably because of this increased access to startup capital, the gaps in business performance are reduced by bank deregulation. I use a lot of measurement to measure business performance, such as profit, employment, and survival rate. So here are related literature and my paper's contribution. So lots of papers look at how to reduce gender and racial gaps in entrepreneurship. For example, scholars find that gender stereotypes of venture capitalists, equal inheritance rights, and reproductive rights may impact the gender gap. However, my contribution is that this is the first paper that finds that access to bank loans can reduce both gender and racial gaps in entrepreneurship. So why access to bank loans is important? Recall that in the motivation part, we find Rob and Robinson's paper find that entrepreneurial firms rely heavily on bank loans instead of equity financing. So it's really important to understand the role of access to bank loan in entrepreneurship. The second strand of literature is about how to measure and reduce discrimination. So previous scholars, they usually use racial gaps in rejection rate, in interest rate in the lending market. However, this indirect measure of discrimination may suffer from some weaknesses, such as some omitted variable problems like discount point. So in Huda and Hismo's paper, they find that if we put discount point in the regression, these racial gaps in interest rate disappeared because minorities, they do not buy a discount point to lower their interest rate. So my paper's contribution is that it builds a direct measure from the narrative information in complaints against banks using textual analysis to measure discrimination. And I also show you that bank competition can reduce discrimination complaints. So this measurement may have several applications. For example, it can help CFPB to detect lending discrimination, which is the main goal of CFPB. Another thing is that This measurement might be useful in other settings. This texture analysis method might be useful in other settings, such as it can help us detect discrimination against consumers and employees if we can use some unstructured data set from BBB and Glassdoor. Right now, the unstructured data set is widespread, so we can take advantage of this unstructured data set to detect lending discrimination, to detect discrimination against consumers. So because of time limitation, I will talk about the data set briefly. I want to talk about the complaint data set from CFPB. So this is the official and the largest complaint data set from CFPB, covering millions of complaints. As for entrepreneurship outcome, I use SIPP survey of income and program participation data set. So this data set is comprehensive. It includes lots of information like demographic characteristics, entrepreneurial firm characteristics, and entrepreneurial firms' financing conditions. And it is also longitudinal. So at each panel, SIPP will track around 30,000 individuals for around 3 years. So because it is longitudinal, we can check the transition from non-entrepreneurs to entrepreneurs. In this part, I want to talk about how to build the bank deregulation index using IBBA and the Dodd-Frank Act. So for IBBA, it effective in 1994. So following the passage, banks outside the state may be allowed to open branches across state line without permission. However, states they are still allowed to use 4 provisions contained in IBBA to restrict or increase the cost of out-of-state entry. So how to build a deregulation index? Based on Rice and Strawhan's paper, bank deregulation index is equal to 4 minus the total number of barrels. So 0 means fully regulated because there are 4 barrels, and 4 means fully deregulated. So if we look at this table gives you the 4 provisions and how to build a bank deregulation index. For example, if the minimum age requirement is 3 years old or more for target bank of interstate acquirers, then I will subtract 1 from the index. And if a state doesn't allow de novo interstate branching, look at the second provision. I will also subtract 1 from the index. I will skip the following 2 provisions because of time limitation. Now let's look at the Dodd-Frank. So Dodd-Frank Act is effective in 2010. So following the passage, banks outside the state they are allowed to establish de novo branches into any other states as if they were chartered in that state. So the timing is simply exogenous because it is mainly driven by the financial crisis. And it is a nationwide act, so it might be under control of the state government and plausibly exogenous to the local economic conditions and entrepreneurial financing needs. Another feature is that this Dodd-Frank Act will impact the state differently. So it will only affect states that do not allow de novo branching before the act. So how to measure the impact? I will add 1 to the bank deregulation index if a state doesn't allow de novo interstate branching before the act, because this Dodd-Frank Act will only impact this provision. So 1 will be added to the index if a state doesn't allow de novo interstate branching, and after deregulation, it will allow de novo interstate branching. And this figure shows you the involvement of the total number of non-interstate branches denoted at blue bar and the total number of interstate branches denoted at red bar. So we know the beginning year of deregulation is 1994. So from this figure, we can see the total number of interstate branches increases a lot because of bank deregulation. And the previous papers find that deregulation will lead to a more competitive financial market because of the entry of out-of-state banks. Then I want to show you my first result, effect of bank deregulation on banking services. First of all, I want to show you that minorities, they are underserved by banks. If we look at these 2 figures, the left figure shows you that there is a negative correlation between the total number of bank branches per 10,000 inhabitants and the minority ratio at the county level. Right figure shows you that there is a positive correlation between minority ratio and the total number of mortgage-related complaints at the zip code level. So I focus on mortgage-related complaints because lots of papers find that entrepreneurs will rely on mortgage to support their businesses. So combining these 2 figures, we can see minority communities, they have lower quantity of branch coverage and they have lower quality of banking services because they have more complaints. Then I want to show you that bank deregulation can improve the quantity and quality of banking services in minority communities. So if you look at column 1, the Y variable is the log of branch density, and the independent variable is the interaction term between deregulation index and the minority community dummy. Deregulation index is ranging from 0 to 4. So 4 means fully deregulated, 0 means fully regulated. Minority community dummy is equal to 1 if a community is located at the top quartile of the distribution in terms of minority ratio. So the coefficient is positively significant. It indicates that a 1 unit increase in bank deregulation in minority communities will lead to a 2.9 increase in the bank branch density at the county level. The unit of observation is the county. So if you look at column 2, the regression is at individual level using data set from SIPP. So the Y variable is the dummy variable equal to 1 if an individual I opens a bank account after bank deregulation, 1 year after bank deregulation. And the minority individual dummy is equal to 1 if an individual I is non-white. So if you look at this coefficient, it shows a 1 unit increase in bank deregulation in minority communities will lead to a 1% increase in the probability of opening a bank account in these newly established branches. If we look at column 3, it measures the quality of banking services. I use the total number of complaints as the measurement. So the coefficient is negatively significant at the zip code level. It indicates that a 1 unit increase in bank deregulation will lead to a 5% decrease in complaints. So then I want to show you that show you an example of a complaint about discrimination. So for example, this complaint received in 2021 filed to the CFPB. It's about a mortgage, and it complained against the BOA. And the BOA's response to the consumer is closer with monetary relief. So it might show that this is the fault of the BOA, the bank, instead of the fault of consumers. So in the consumer complaint narrative information, in the first paragraph, the consumer says, I believe I'm being discriminated against because I disclosed my rates and blah, blah, blah. And if you look at the second paragraph, it shows a quick summary of my background. I have excellent credit. My credit score is over blah, blah, blah. So how to measure discrimination? So if a complaint's narrative information includes the following words: discrimination, unfair, inequity, prejudice, injustice, or other related words such as discriminating, I will count this complaint as a discrimination complaint. So how to validate my measurement? I find that minorities have high rejection rate in banks with a higher volume of discrimination complaints. So it shows this measurement may have some real impact on the rejection rate and the interest rate in the lending system. Then I want to show you the effect of bank deregulation on discrimination. So I use 2 outcome variables: the instance of discrimination complaint at the zip code level, and the total number of complaints about discrimination also aggregated at the zip code level. So if we look at the coefficients of these interaction terms, we can see a 1 unit increase in bank deregulation in minority communities will lead to a 4% decrease in the probability of the instance of discrimination complaints, and a 3% decrease in the volume of discrimination complaints. And my results are mainly driven by incumbent banks. So it means when out-of-state bank enters the local market, the discrimination level of incumbent banks will decrease because of intensified competition brought by the out-of-state entry. Then I want to show you the second part of my result. Bank deregulation can reduce entrepreneurial gaps in the following 3 aspects. So if you look at 2 categories, the first category is about business formation. So how to measure business formation? I use a dummy variable. It is equal to 1 if an individual I transitions from non-entrepreneur to entrepreneur within 3 years after bank deregulation. I use two interaction terms: bank deregulation index by minority dummy, bank deregulation index by women dummy. So I use the individual level data set from SIPP. So if we look at column 1, we can see minority and women, they are more likely to be entrepreneurs after bank deregulation. And if we look at column 2 and column 3, we can see that conditional entrepreneurs, so this regression in the conditional entrepreneurs, also at the individual level, we can see minority and females, they are more likely to get access to more skilled business debt and mortgage debt after bank deregulation. So I also have some additional results, but because of time reason, I will talk about them briefly. So I also find that bank competition can reduce the gaps in business performance and business equity. Business performance is measured by employment, profit, and survival rate. And I also find that it can also reduce the gaps in access to PPP loans. This can rule out my alternative hypothesis that my results are driven by the default risk of minority and female entrepreneurs, because these PPP loans are risk-free. They are guaranteed by the US government. So banks don't need to worry about the default risk. And I also want to show you that my results are stronger in areas with high discrimination. So it is consistent with Becker's discrimination theory. Bank competition can reduce discrimination. So the effect of bank competition will be stronger in areas with higher discrimination level. And it will also be stronger in industries that rely heavily on external financing. And let me conclude. So in this paper, I take advantage of the two important bank deregulation acts to analyze the effect of access to finance on entrepreneurial gaps. I find the following results. First of all, I find that competition can reduce gender and racial gaps in entrepreneurship in the following several aspects: business formation, startup capital, business performance, and business equity. The underlying channels are that bank competition can improve the quantity and quality of banking services and reduce discrimination. So as for policy implications, my paper underscores the need for policy intervention aimed at financial inclusion for female and minority entrepreneurs in the entrepreneurial financing market. And my measurement might be helpful to detect and disclose discrimination and reduce discrimination treatment in the real world. So thank you so much for your time and attention. Yeah, I look forward to your comments and your questions. Thank you so much.
Well, let me start by saying thank you to the organizers for inviting me here and giving me the opportunity to read this really nice and very interesting paper. So in the interest of time, I'm going to skip the overview because the presenter did, an excellent job. So overall, there's a ton to like in this paper. I shouldn't have to talk about the importance of this topic for everyone. Just the mere fact that the racial and gender gaps in entrepreneurial activities established is a big deal. And talks about how bank deregulation narrowed these gaps that is first established. So there's a lot to like. It's a very thorough paper. It's actually my kind of paper where there's this big problem, attacks the problem from many different angles, uses different data sets. So there's a lot of very careful data work that went into it. Just the expansion of the Rice and Strain Index is worthy of praise. There's, it's an 89-page paper with all these Westlaw references for deregulation actions and things like that. So it's a very thorough paper. The main empirical findings are convincing about transition to entrepreneurship. It's a paper with a lot of moving parts, so there's a lot going on. So in parts, it's not the easiest read, but it's certainly worth the time and effort, so I really enjoyed it. So my main comments is 3 comments. I probably won't get to the third one, but let's see. So I want to say a few things about the timing and this competition mechanism, some comments on data methodology, and then if I get to it, some gentle suggestions on improving or streamlining the paper. So the issue with timing and mechanism is, so deregulation is something that I've done a little bit of work on too. I will break the rule and mention one of my papers too. Someone mentioned that's never a good idea, but I'll do it anyway. So basically there are 3 waves-ish of deregulation. So there's a pre-1994 where it was up to the states. States starts with Maine in 1997 or something like that. And then, so there's a bunch of papers that look at just banking deregulation before 1994. I listed a few and find a whole bunch of positive effects. There's, faster income growth. There is more entrepreneurial activity, which I will mention the current Randa paper again. There is more student loans for human capital growth. I have some work that finds that there is more credit for energy efficient durables. And then there is this 2006-ish period of it where after Regal-Neal, states could still have some restrictions in a roundabout way. And there's a whole bunch of papers that look at that period, and they also find a bunch of things. Like, so Rice and Strahan finds lower interest rates, there's more mortgage credit, there's more patents, more innovation. And now comes along this paper that looks at basically post-Dodd-Frank, and they find a whole bunch of things like less discriminatory lending, increased access to PPP loans. So I was like thinking, like, this is 30, 40 years of deregulation. It seems to be the gift that just keeps on giving. Like, anybody who looks at any period of deregulation finds something. So I find myself wondering, what's happening when? For example, Rice and Strahan, that this paper builds upon, finds that there is no increase in access to credit. There is just credit becomes cheaper. This paper finds that there's actually more access to credit. So, I mean, there's a broader question of what's happening when. Is the impact evolving? Is it first start with lower prices, then higher quantity? So I was wondering the timing of this, that, does some of the outcomes need more time to show themselves? The mechanism is slower. I mean, this is a paper that spans 30 years of data, so I thought it was worth some discussion. The other issue is, and I mean, there's a couple of different things going on in the paper. It's an issue of when do these gaps actually close due to deregulation. I mean, you're looking at the index after 2010, which is a non-trivial portion of the sample, there's only 27 states have any deregulation activity, and some of these are relatively small states, like Montana. So a lot of the deregulation shocks after 2010 are coming from a few states. So it's not immediately clear what's happening in this later part of the sample. There are 10 states that have no change in index period at all. Like, for example, Michigan starts as fully deregulated, just continues that way throughout the entire time. Now, this comment is maybe now a little bit unfair because there are two specifications in the paper, unless I misunderstood it. So the main specification, entrepreneurship, is defined as transition within 3 years of a change in the index. But then there's this really interesting figure 3, where there seems to be another specification where more than 3 years after deregulation is also included, and there's a lot of significant effects coming there. So I couldn't figure out what was going on with the horizons. I went with the figure 3 specification. So there, +3 is actually that time period. There's a big impact on transition to entrepreneurship. So then I was wondering, if we go with that specification, should we really look at a transition to entrepreneurship, let's say in 2010, for someone living in Michigan, which fully deregulated in 1995? Like, other things may have happened. So there seems to be some time elapsing, at least based on figure 3. So the question is, what's the mechanism? Like, so is this thing happening in stages? Like, first you get a student loan, you go to college, you build human capital, then you transition to entrepreneurship. I mean, might be far-fetched, but there's some interesting stories there that are not really being explored. I mean, in all fairness, there's a lot of data work going on, so maybe there's not time to do everything. But at a minimum, just cross-tabulations of these entrepreneurial gaps based on states, the stage of deregulation, timing, time periods, those would be super helpful. The other issue, of course, is that what's the increased competition mechanism? So is this new incumbents just saying, hey, there's this underserved community, let's go lend to the best of the best female and minority entrepreneurs with great ideas. It's an easy way to get market share. Or if so, there's all this literature on soft information, like they're new in an area, how do they overcome informational problems? There's this older literature on bank deregulation leading to credit scoring adoption. Scott Frame, I think Bob DeYoung has done some work on that. So is it about better technologies? The incumbents are now, let's get better technology to make lending decisions. Who is making these loans? Is it the new entrants? Is it the incumbents? It's everybody. And again, perhaps an unfair comment since data challenges are obvious. But I mean, for example, some of the PPP literature has worked on, how much banks should have lent PPP versus how much they actually lent, and being able to compare, who is doing more lending than they otherwise should. I think some discussion would be very helpful. Data and methodology, I'm actually going to skip the first comment because, again, the issue is the index is primarily only improving over time. So I was left wondering the question of, so let's say by the end of 2000, there's still a whole bunch of states that are either very tightly regulated or completely or very tightly regulated, whereas after 2010, there are no fully regulated states left. They only have 1 or 2 restrictions in place. So should we expect similar results, that a state removing its last regulation out of 4 versus going from fully regulated to, having 3 regulations? Like, is the effect linear? Does the type matter? Does which restriction is being removed? Does that matter? So those are all interesting questions that are very thought-provoking, might actually need some attention. So long wish list. I already mentioned some. In the interest of time, I will skip some of them. I am interested in figure 3 because the specification seems to be different and the results look very interesting. So I'd like to know more about figure 3. Kerr and Randa actually find that bank deregulation leads to a lot of entrepreneurial churn. So people start businesses fail, and then they maybe start another business. So some discussion of survival. They do find that minority and female entrepreneurs start firms that are more likely to survive, but not all of them are going to survive. I would be interested in seeing if there are any serial entrepreneurs in the data, and gender or racial cuts of that would be very interesting. And again, it's a data-heavy, very careful paper, but observation counts are constantly changing within tables, across tables. Some explanation of what's happened to the sample would be helpful because, again, there's a lot going on. It's all very interesting, but some stuff needs more explanation. So my gentle suggestions, how much time do I have? Not much. Okay, so let me say 2 things and then I'll stop. CFPB complaints, I really like the idea. It's a great idea, but the implementation is really cool. It's just the data starts kind of late in the sample period, and there are not a lot of complaints. So I went to the CFPB database. For 2015, for example, there were only 162,000 complaints. Only 55,000 of them have any narratives. And there are 40,000 zip codes in the US. So they announced at the zip code level. So I was left wondering, how many zip codes didn't have any, is this like a network effect where in certain areas, people are more likely to complain to the CFPB? So that would be interesting to ponder. And the last thing I'll say, 5 and then stop. There's already a big literature on PPP. We're going to see a paper on this, very soon. So the PPP extension, it's interesting, but the paper is 89 pages. There's a lot going on. So I was left wondering maybe that could go into an appendix, or maybe it'll be, maybe a consideration of whether it's necessary or not. But, that's a minor point. Overall, super careful, really interesting point, the interesting paper. The main point is really convincingly made. All of my comments are just improving the flow of the paper. I mean, it is 89 pages, but it's a great paper. I really liked it. I recommend everybody read it. Thank you.
Thank you so much. Do we have one question maybe from the auditorium? Yeah? Do we have a mic?
See you today. I really enjoyed the paper, but there's an elephant in the room that's being ignored, and that's online banking. And online banking started at the beginning of this period, but really came into effect starting about 2010. And we don't know really what the effect is for online banking here. We see a drop in the number of branches starting around 2012, probably due to online banking. Online banking could increase competition, and that's one of the arguments you're making, but it also can discriminate. And we know that because of the digital divide across gender. We've already heard about that today. And it can discriminate in the digital divide by ethnicity. And furthermore, there's a digital literacy issue that comes into this that we heard about earlier. So it'd be really interesting to incorporate the effects that online banking might have here. And there are many measures that you could have. The number of million clients that different banks have that are using online banking services, that's readily available and might be some indication of that. But I think it really is something that's very important to consider in the analysis. It could strengthen the results, it could reverse the results, we don't know. But a very, very important issue if you're going to be looking at the effect of banking.
Thank you. Hyun, back to you, maybe for a brief wrap-up.
Yeah, thank you for the gentleman's question. So I want to answer this question first. So I think it's a really good point. I will definitely think about the role of online banking. So in my paper, I can link it with my paper to some extent. In my paper, I find that if you look at the PPP loan setting, in less competitive areas, minority entrepreneurs, they are more likely to go to online banker, to go to some fintech lender to get loans, to get PPP loans if this area is less competitive. So it means online banking may complement the role of the traditional bank in less competitive market. As for Professor Avery's excellent discussion, I really enjoy your discussion. Yes, your points are well taken. I will definitely follow your suggestion to provide my paper, and maybe I can talk about it some point. So if we look at the aggregate effect of the credit supply, yeah, in Wright and Strahan paper, they don't find that the total number of loans will increase after bank deregulation. I guess one reason is that it's because of time horizon. Another reason might be, in my paper, I find some distributional effect. So for example, there might be some credit reallocation from less productive white and black entrepreneurs to some more productive black and female entrepreneurs. So there might be some credit reallocation effect instead of the total credit, increase of the total credit. I will definitely decompose my period into some subsample period to look exactly the effect of different periods. So for example, after the financial crisis, maybe bank merger and acquisition will play a very important role in competition landscape. I will also definitely check the effect of each provision by decomposing my index into 4 indicators representing each provision. And I will also pay attention to the sample size changes, and I will discuss it more carefully. As for the PPP loans, yeah, I will think about it. I may put the PPP loan setting in the appendix. Yeah, thank you so much for your time and attention and your discussion. I really enjoyed it. Thank you.
Thank you. Next up, we have Rudy Hung from Southern Methodist University, presenting his paper on the impact of minority representation at mortgage lenders, jointly with Scott Frame, Eric Meyer, and Adi Sundara. Floor is yours.
Good morning. Thank you very much for having me here. This is joint work with, I'm Rudy Huang from Southern Methodist University. I'm assistant professor of finance there. And this is joint work with my colleague Eric Meyer, and also Scott Frame from the Dallas Fed, and Adi Sundara from Harvard Business School. The usual disclaimer applies. This is our opinion, not the Federal Reserve Bank of Dallas or any entity within the Federal Reserve System. This actually echoes what Governor Cook said earlier. So racial disparities in economic outcomes are striking: wealth, income, education, health. And it's been a focus of policy and research to better understand and address those disparities. There are some historical and obvious reasons why there's disparities, such as discrimination, but there are also less obvious ones. For example, if you match minority students with minority teachers, the minority students have better outcomes. And if you match minority doctors with minority patients, the minority patients' health outcomes are better. So basically, research shows that disparities can be self-reinforcing. So racial disparities in labor markets may lead to disparities in the provision of critical services. So when minorities are underrepresented in the roles that provides critical services, that will harm minority outcomes overall, right? So in this paper, we evaluate the impact of minority representation at financial institutions by looking at the universe of mortgage loan officers in the United States and to study the US residential mortgage market. And arguably, this is probably the most important credit decision every household has to make, not to mention the benefits of home ownership and associate benefits of that, right? So this is our paper and our results in a nutshell in 2 graphs. So here we plot the mortgage approvals and the default rates in 4 graphs, and those bars of the screen really cuts the graph. Difficult to see, but bear with me. So on the very left-hand side panel, where we look at white loan officers, and when they work with white applicants and minority applicants, you see they approve fewer minority applicants. And when you look at the second panel, where that's for the minority loan officers, they actually close the racial approval gap. So what is going on here, right? 2 potential reasons. The white loan officers are discriminating against minorities by approving fewer loans, or the minority loan officers are maybe better at their jobs, know something their white counterparts don't know. So we turn our attention to mortgage defaults to see what's going on. Because if it's a discrimination story that white loan officers are approving fewer loans, then they should have also lower default rates, right? But what we see here is that under white loan officers, minority applicants have higher default rate, and again, working with minority loan officers, they close the default gap as well. So takeaway from here is that working with minority loan officers, they are approving more applications and with lower default rates among the minority applications. This tells us that the minority loan officers have an information advantage over their white counterparts in helping minorities securing their mortgages. And here, one thing you might notice is that there are some level differences in the plot, and you might be thinking that maybe minority loan officers are approving fewer loans overall, but that's actually not the case. This is the raw data, so we have no control variables whatsoever in those making those graphs. And traditionally, minority loan officers tend to work in lower income neighborhoods. So those are the people with lower credit score, worse credit quality. So by design, they have lower approval rates in those neighborhoods. That's why you see a lower approval rate. But once we control for everything, as I will show you throughout the presentation, you will see that there's basically no difference in the level. It's only in the gaps. Okay. So basically, our paper in a nutshell, we link the near universe of mortgage loan officers to the applications they handle. And what we find is that minorities are significantly underrepresented among the ranks of loan officers. And minority applications are more likely to be completed, approved, and originated when working with a minority loan officer. And despite minority loan officers approving more minority applications, they have a lower default rates consistent with an information advantage story. And then lastly, we want to show that underrepresentation definitely matter. It can account for up to half of the unexplained ratio gap in mortgage markets. So the data here, it's a massive data exercise, and we're starting with the nationwide mortgage licensing system, the MLS data, which allows us to observe the population of licensed registered mortgage loan officers in the United States from 2012 to 2019. So we know their loan officer permanent ID, their work address, as well as their employment history, and we somehow code their race using some sort of algorithm. And we merge the loan officer data to the confidential Home Mortgage Disclosure Act, the CHMDA data, which gives us the borrower information, especially after 2018, where they expanded the CHMDA data. We can observe the borrower's race, credit score, DTI, good stuff like that. So that's where our second data set. And then lastly, to measure loan performance, we use FHA's loan origination and performance data on the universe of FHA mortgages from 2012 to 2018. So at the end of the day, we have the linked data coming from 2 things. So first is the near population of home mortgage purchase applications for 2018 to 2019. And we have the population of FHA home purchase mortgages for 2012 through 2018. And so first, very quickly, minority representation among loan officers. So here, looking at the table on the left-hand side, you see out of almost 250,000 loan officers in the US, about 85% of them are white. Comparing to the US population, which only 61% are white, we can definitely see that mortgage loan officers are underrepresented. And on the graph on the right-hand side, where we plot at the zip code level minority population share against the loan officer minority share. So if there is a one-to-one relationship between the minority loan officer share and population share, you should see a 45-degree line, right? That's the solid black line over there. But what our data tells us is that it's way below that, which means that minority loan officers are definitely underrepresented across almost every single zip code in the US on average, of course. So now let's get into the results on minority loan officer and their access to credit. So without even do any regression or any fancy econometric technique, just a simple tabulation tells us that minority loan officers may help reduce racial disparities. So looking at completion rates, so whether this is where someone actually go in, put all the paperwork, and actually complete their mortgage application. And what we see here is that under white loan officers, there's a little bit of a gap where minorities are less likely to complete applications, about 3 percentage points. But if working with minority loan officers, they definitely help to close that gap. And second, if we look at the approval rates, given the application is completed, there is about 5 percentage point gap working with white loan officers for minority and white applicants. But again, for minority loan officers, they close more than half of that gap. And overall, looking at the very bottom row over there, so it's all in origination. So basically what we mean is the application has to be completed, approved, and taken up by the applicants. And there is about an 8 percentage point gap working with white loan officers. And for minority loan officers, we see they definitely close the origination gap for white and minority applicants. So this is just some simple summary stats. So let's get more serious and run some regressions. So in our baseline form, we regress our outcome variable y, which could be completion, approval, and all-in origination, on basically an indicator for whether the borrower is minority and an indicator for whether the loan officer is a minority and the cross term. And we also throw in a lot of controls thanks to the new HMDA data, including very granular bins of FICO score, LTV, DTI ratio, and all that good stuff with a bunch of fixed effects. And here's what we find. So starting with completion again, so the very first row in column 2, working with a white loan officer, minority applicants are 1.9 percentage points less likely to complete their application. But working with a minority loan officer, they are 1.1 percentage points more likely to help them completing their application, so closing more than half of that completion gap. And when we look at approvals, here we basically split our sample into 2 for low discretion versus high discretion cases. What we mean by low discretion versus high discretion is that there is this automated underwriting system the bank uses, and for most applications, it basically goes through, and when the cases come back saying maybe, that's what we call high discretion, in which cases it needs more loan officer input, right? And so in those cases, you see in column 6, working with a white loan officer, minorities are 2.6 percentage points less likely to get approved, but working with a minority loan officer, they close 1.4 percentage points of that gap. So again, more than half of that approval gap. And here is our all-in origination results. Again, the same thing. Working with white loan officer, there is a gap, and the minority loan officer definitely help to close that origination gap. And here you might ask me, hey, some other stuff could be driving this. For example, there could be endogenous matching between loan officers and borrowers within the branch. So the idea is we want to achieve some sort of quasi-random assignment of loan officers to their borrowers to help strengthen our causal claim. So we use loan officer work schedule rotations to instrument for an application being handled by a minority loan officer. So we basically compute the fraction of applications opened at the same branch on the same day of the week during the last 12 weeks that were handled by minority loan officers. So the idea here is that if there's a minority loan officer who are handling lots of applications in the last 12 weeks, on a Tuesday, he or she is going to be more likely to handle minority applications Tuesday of this week, right? So the exclusion restriction here is that the instrument affects application outcomes only through its influence on whether a minority loan officer handles the application, and you have to trust me on this due to time. The first stage looks very strong, and the covariates definitely balanced. Okay, so the results are very similar to the OLS results. Let's just look at the very last column in the sake of time. Working with a white loan officer, they originate about 5 percentage points less origination rate, but working with a minority loan officer, they close 3.8 percentage points of that gap, so more than 70% of the origination gap using our instrument variable approach. And here's the more interesting part of the paper. So what's going on, right? Additional origination by minority loan officers could be due to they're at higher risk or less taste-based discrimination or information advantage. So we turn our focus to loan default or loan performance to distinguish between those alternatives. As you can see here, this is the graph you see at the beginning. Working with a white loan officer, the minority applicants have higher default rates, but working with minority loan officer, they close that default gap, right? So this tells us that minority loan officers help to equalize default rates. So this means that basically they're originating higher number of loans with lower number of defaults. They have an information advantage over minority borrowers compared to their white counterparts. So this suggests an information advantage, but we want to show you more evidence on the mechanism from the cross-section as well as from different reactions to hard information. So looking into the cross-section, our results that minority loan officers achieve higher approval and a lower default with minority applicants is stronger for officers and applicants of the same race, ethnicity, so there's more information going on there, and also applicants with a lower income. That's when the hard information is noisy, and when applications at small banks and results are very weak at fintech firms, and when minority loan officers who have experience handling minority applications, all suggesting that there is a soft information advantage. And how about differential reaction to hard information? So what we do here is that we separately looking at the applications handled by white loan officers and minority loan officers, looking at the approval rates for minority applicants. And we basically regress whether the application got approved, whether it's a minority or white applicant, on all the hard information. And we see only difference among the hard information is credit score and debt to income ratio. So what does this tell us? So what we see here is that minority loan officers are actually penalized less for borrowers with a lower credit score and a higher debt-to-income ratio. So under hard information theory, if you have a lower credit score, higher debt-to-income ratio, you have a lower credit quality, right? But for minority loan officers, they are more likely to approve those loans, which means that they have a soft information advantage for minority borrowers. So we have some notable non-results. So first one, we don't see results stronger at institutions with larger fraction of minority loan officers. And the results do not vary depending on how competitive the local mortgage market is. And we also do not see any results on loan pricing. Lastly, I want to have a takeaway. What's the economic importance of minority representation? So the one sentence conclusion is minority representation matters, but let's walk through a little bit of a thought exercise. So in our data, 95% of white applicants work with a white loan officer. However, only 22% of minority applicants work with a minority loan officer. So minority loan officers' workloads are already tilted towards minority applicants. They handle about 66% of minority applicants. So if there is a significant increase in minority representation, would be required to equate in-group benefits across racial ethnic groups. So what we're trying to do here is, what if minority applicants were as likely to work with a minority loan officer as whites are to work with a white loan officer? So we're trying to increase the rate from 22% to 95%. And if we can achieve that, this would reduce about 46% of the minority origination gap. So that's pretty much the paper. Thank you very much for having me here. Looking forward to the discussion.
Thank you very much. Fascinating. We've now got Robert Clark from Queen's University for the discussion.
Okay, thank you very much to the organizers for including me in the program. It's my first time at this conference, and it's been a real pleasure to be here. I've learned a lot. There were a lot of excellent papers and very thoughtful discussion, and so it's been great. So let me turn to my discussion of this paper. Thanks for asking me to discuss. It's an excellent paper. Let me try to do three things. I'm going to provide a very quick high-level summary of the paper, but Rudy did a great job, so I don't need to go into any details there. And then I'm going to try to tell you why you should care, although again, I think he did a good job of that. And then I'll wrap up with 4 or 5 points that I'll call comments, questions, suggestions that'll hopefully help you take more away from the paper and will help Rudy in any revisions he's engaged in. So the authors do some amazing data work. They nicely combine 3 data sets to construct a data set that can allow them to answer the questions that they're interested in. So they're going to start with a panel of loan officers. They're going to construct this panel of loan officers, and they're going to identify loan officer race by doing some name geocoding. And then with this data set, they're going to match it with mortgage application data that they get from the HMDA data set, and with mortgage origination data from the FHA data. So then with this combined data set, they're going to do 4 things. So they're first going to document underrepresentation of minorities. Excuse me. So whereas minorities account for 39% of the US labor force, they find that they only account for 15% of loan officers. Then they're going to highlight the lack of credit access for minority applicants. So they're going to find that origination is 5 percentage points less likely for minority borrowers than for white borrowers faced with the same white loan officer. Oh, thank you. And then their key result is that they're going to confirm that minority representation can matter. And so this 5 percentage point gap that they find when faced with a white loan officer is shrunk when they face a minority loan officer instead by roughly half. All right, and then they're going to investigate whether this has to do with information or discrimination. And one thing you might, or at least a skeptic might be worried about, would be that the fact that they're allowing for more origination amongst minorities might mean that they're approving weaker loans somehow. But in fact, they're going to show that minority representation has no adverse effects on loan outcomes at all. Okay, so that's sort of the high-level summary of what this paper is about. Why should you care? Well, in a nutshell, minority representation matters. And this has been documented in other very important contexts before. So Rudy mentioned the education context, which I have here as well. But in addition to that, it's been documented in the judicial system. So there's a significant racial gap in sentencing, but this gap is smaller among black judges than it is amongst white judges. K-3 black students with at least 1 black teacher are more likely to graduate high school and more likely to go to college. Okay, so it matters, and what we're starting to learn is that it matters for mortgage lending too. And so minority outcomes, we've documented that minority outcomes matter or are affected in a variety of ways by whom they face when they're applying for various types of loans. This can manifest itself through the offering of inferior menus in terms of rates and points that are offered to them. It can manifest itself through the refinance opportunities that are provided to them. And then what we're learning here is that it can also matter through the composition of the loan officer workforce. And all of this matters because mortgage markets are important. Home equity is a critical source of household wealth. And if certain parts of the population don't have access to the same levels of credit, then this can contribute to the inequities that we see in our society. Okay, so let me mention 5 comments, questions, suggestions. So the first is more of a comment to think about the challenges, the empirical challenges that are faced by anybody that wants to try to answer this question. So what's the problem? The problem is that race is not randomly assigned, and so any regression analysis is going to suffer from an omitted variable bias. So the judge and teacher studies that I mentioned, they're going to exploit random assignment or some sort of quasi-experimental variation. Random assignment is not going to be possible here. We're not going to be able to randomly assign loan officers to applicants and vice versa. But I think we saw that we did a good job, the authors do a good job of taking advantage of their data to approximate quasi-experimental variation. And so I think we should be pretty convinced that they've done a good job there. Okay. Then in the conclusion, we were learning that the mechanism that they're proposing as being the key factor here is one about soft information, that their results are consistent with a story where somehow there's better soft information if minorities match with minority applicants, minority loan officers match with minority applicants. So just a little bit of pushback here. I'd like them to think a little bit more about the definition of soft information here. My reading of their results is this was a lot about the willingness to take the time to help applicants complete the paperwork, that was one of the big channels through which this gap was closed. And I mean, there's probably an interpretation, a soft information interpretation of that the minority loan officers can recognize minority applicants that are worth spending the time on. But I'd still like them to work through that a little bit more. And here's maybe a suggestion that they could possibly use to try to further convince readers that soft information is important. Other work by some people in the room, by Jason Allen and by Everin, has used the destruction of soft information caused by mergers to help identify changes in soft information. And so that might be something that they could exploit as well in this context, okay? Another point is about the role of fintech. So Rudy kind of alluded to this towards the end of the talk, that maybe fintech can play a role here if we move to sort of more algorithmic decision-making for who gets approved for loans. That could possibly help. And I think that that's likely true, except we've seen with some recent lawsuits, class action lawsuits in the States versus major banks, that the information that you feed into the algorithm is going to matter a lot. And it looks like, at least in some cases, the information that's fed in yields outcomes that are inferior to human-based decision-making. And so we need to at least be a little bit careful there as we move towards algorithmic decision-making. And then we got a little bit of policy takeaways at the end there. And the policy takeaway was naturally that we need to try to have more minority representation amongst loan officers. And I agree with that, but I think we have to think hard about how that's going to take place. How easy is it to expand the pool of qualified minority loan officers? How does this link to the current debate about affirmative action? If we end up moving away from affirmative action, does that limit the ability to put these kinds of changes into place? I think these are discussions that the authors need to think about. And then a very last point, one of my sort of Bank of Canada discussion tricks is to try to redo whatever analysis I've been asked to do on some US-based paper using Canadian mortgage data. And it turns out that's not possible here. We don't collect information on loan officers, and we certainly don't collect information on their race. So maybe that's something that we need to think about in a Canadian context. Okay, so let me wrap up. Hopefully I haven't gone over time. It's a really nice paper. I encourage you all to read it. I think it's making a really important point. It's doing so by combining really great data that they had to work hard to put together. They do some very careful empirical analysis and derive some important conclusions. And so I would just push them to work a little bit harder on pinning down the mechanism and thinking a little bit more about those policy takeaways. Okay.
Excellent. Thank you so much. I'm afraid we are running a bit low on time. Very quick question. Very quick.
It's not actually a question, it's more for people in the room as well. A bit of just advertisement on some of the posters outside that talk about some Indigenous economics issues. And in particular, there's one that the Reserve Bank of New Zealand has provided talking about challenges of access to credit among the Maori population there. And I'm raising that issue because I think this soft information issue becomes really important at times when we're looking at potential cultural differences. And in hearing a presentation earlier, not at this conference, on that access to capital, it seemed like this was going to end up being an important thing to be considering in improving access to capital among that population. So it's not a question, just more look at the papers outside and I think some broad-based interesting things in that soft information pool.
Thank you. Rudy, do you want to get back to the discussion at all?
Thank you. All points are well taken and appreciate it. We actually have 112 pages of exploring the mechanism inside the paper. We'll dig further. Thank you very much.
Super, thank you. So we're now on the third paper of the session, presented by Asani Saka of the Federal Reserve Bank of New York, on applications or approvals, what drives racial disparities in the Paycheck Protection Program. That's joined with Sergei Chernenko, Nathan Kaplan, and David Shafstein. Floor is yours. Thank you.
Thank you very much, and thank you for the opportunity to present here. Really appreciate it. This is my third time in Ottawa, and it's really great to come back and see old friends and attend this very stimulating conference. I learned a lot. So I have I have to start with a disclaimer that this is my own opinions, and they do not represent those of the Federal Reserve Bank of New York or the Federal Reserve System. So the paper is about applications or approvals. It's talking about racial disparities in the PPP program, something that has been alluded to.
I apologize for interrupting. Can you speak into the microphone, please?
Into the microphone. Okay,
thank you.
Sure. Which has already been alluded to earlier in the conference, and as mentioned, this is joined about Sergei Chernenko, Nathan Kaplan, and David Shafstein. So do I press this to move the slide forward? Yeah, okay. Oh, top green button. This one? No. The big green button. Big green, okay, got it.
The top one, yeah.
Oh, this one, okay. It's just too obvious, you know. There's a vast literature which is documenting disparities in access to credit between white and Black Americans, or more generally, minority Americans. The previous paper talked about mortgage lending, and there are other types of credit instruments. Now, more recently, there's been a paper looking at credit disparities in the context of the PPP. And this is PPP is a really nice laboratory in which to examine these issues, because the way the program is structured, essentially there's no credit risk to lenders. So you can rule out certain types of mechanisms, such as statistical discrimination. So this literature, we are going to highlight 3 results, which is going to be important for our paper. First, the literature finds that there's a disparity in the take-up of loans, which is to say Black-owned firms are less likely than observably similar white-owned firms to receive PPP funds. Secondly, there's a reliance on fintech lenders in the sense that conditional on receiving a PPP loan, Black-owned firms are less likely to receive the loan from banks and more likely to receive them from non-banks, in particular, fintech lenders. And finally, in terms of channel, the literature uses various measures of racial bias, and they find that these disparities are in part can be explained by these measures of racial bias. So that's a starting point. And now what we do in the paper is, as you know, the loan take-up is a composition of 2 things. It's a composition of the application rate and the approval rate. So the key thing that we are doing in this paper is we are decomposing these results into how much of it is attributable to on the application side and how much of it is attributable to the approval side. And these disparities between banks and fintechs, how do they show up in the approval stage vis-a-vis the application stage. Moreover, we're going to analyze the channels behind these disparities in approvals and applications. So we're going to look at some of the channels which has been examined in the literature in the context of take-up, which is observable firm characteristics, pre-existing lending relationships, and racial bias measures. But we're also going to look at other factors that potentially may generate these disparities. So for example, is there a demand factor that for whatever reason, minority owners are turned down funds at a greater rate? Is there eligibility issues? And finally, and this was alluded to in the previous paper and by the discussant, are there issues in navigating the application process and in completing all the documentation requirements? And I should mention that this kind of links to this. There's a very large literature in public economics and micro, which is looking at administrative burdens and how this affects various public programs, such as SNAP and Medicaid and so on. So this is an important issue in public policy. Okay, so I know I'm the last person in the conference. I'm very mindful of the time. So let me preview the results in case I don't get to all of them. So the first thing we do is we are going to use a different data set. So we're going to use this very unique survey data rather than the PPP admin data. So the first thing we want to do is to make sure that we get our results kind of replicate the existing literature. So that's the first thing we do. And we do this replication both quantitatively as well as qualitatively. Having done that, then these are our new results, which was first regarding the application rate. What we find is that these disparities which have been shown in the literature between observably similar white and black-owned firms is that half of these disparities in the take-up is explained by application rates and the remaining by approval rates. So decomposing those two things are important. Moreover, the result on the reliance on fintechs relative to banks is completely explained at the application stage. So we find this is a very interesting result. So specifically what we are saying is that black-owned firms are substantially less likely than white-owned firms to apply to banks and substantially more likely than white-owned firms to apply to fintechs. So there's a sorting from banks to fintechs by observably similar black and white-owned firms. However, what we find is at the approval stage, the application disparities are very similar. Okay, so to the extent that fintechs are helping, it's really by expanding the pool of application. It's not doing anything in terms of reducing approval disparities. Final result is that, consistent with the prior literature, we find that racial bias is related not just to take-up, but it can explain application and approval disparities. However, we find that other factors, non-racial factors, are also important. And in particular, we will talk extensively about these administrative burdens in terms of being able to provide the necessary documentation and calculate loan amounts. Of course, a caveat here is that these other factors could themselves be outcomes of a legacy of bias and discrimination. Okay, so what's the contribution of this paper? So first of all, we do this decomposition, and we feel that this is really important to understand this because it's important for policy. Because in terms of policy, what we want to do is how do we improve the programs, right? How do we kind of reduce the disparities? And then you kind of want to know where the source is coming from. So is it coming, do we need to do better outreach? Do we need to simplify the application process, provide more technical assistance, and so on? Secondly, there's this big debate now on the use of technology to potentially address some of these issues. And we bring some nuance to this debate. So it has been suggested that automation could potentially reduce the impact of racial bias because it takes off, with the human loan officer who's actually making the decision. But what we are finding is that this could be true, and we do find results that the fintechs are reducing the effect of racial bias. However, as I said before, this does not seem to reduce the approval disparities. So the technology, in the sense that it's helping, it may be the way it's helping is by improving these, by attracting more applications. So in a sense, it talks about the limits of automation. So automation may be helpful, but it's not a panacea. It's not a magic bullet. And this is consistent with evidence in this famous paper by question mark, which is actually should be Meyer and Wu, and in the context of Medicaid and SNAP, they find similar results about automation. And finally, in terms of mechanism, we'd like to also talk of, emphasize this idea of administrative burdens, which again, there's a literature which shows that these administrative burdens in the context of other public programs are particularly cumbersome for disadvantaged groups. Okay, so let me get on to the meat of the paper. So we're going to talk about the data and the results. So just briefly, this is an annual survey conducted by the Federal Reserve. It's a convenience sample. So there's an outreach to partner organizations through the internet. It's a snapshot. The survey was conducted in the fall of 2020. So this is the fact that this is a convenience survey is good and bad. It's bad in the sense it's not a random sample, so we have to be careful about representativeness. But the good thing is that means that we don't have to worry so much about fraud, and that could potentially contaminate analysis because the literature finds that fraud could potentially be something more of an issue with fintech lenders. So we think we don't have that problem with the data. The main advantage of data is we actually get data on race, ethnicity, and owner characteristics and relationships. In a lot of other papers, you have to kind of indirectly infer race and ethnicity through the racial profile of a geographical location. But we have direct information, so that's very helpful. And then we have these measures of racial bias that has been used in other literatures also. So just briefly, in terms of, as I mentioned, that we have to be a little careful that our survey is a representative of the, of the universe of small business. So this is representative by geography, and it shows that it's very similar. Our survey is a little bit kind of sparse in the Midwest, but other than that, it doesn't look that different. It's also pretty representative by industry. There are some differences. The reason there are some differences is that there's an overrepresentation of employer firms in SPCS. And then I won't go through the summary statistics, but basically these are the things that we have in the regression. We have like a rich set of firm observables. And the main takeaway here is something that is well known. It's been mentioned several times in the conference that minority-owned firms and Black-owned firms in particular, they tend to be smaller, they're less profitable, and they're younger. Okay. Then moving on. Okay, in terms of PPP outcomes, the unconditional outcomes are very similar to the results that we'll show. That there's the Black-owned businesses tend to apply less relative to to white-owned firms. Then there's this reliance on fintechs relative to banks, and but in terms of the actual take-up, there's in terms of the take-up, there's this reliance on fintech. Okay, and these are all the zip code characteristics that we use in the regression. Okay. Okay, so now we have to get to the regression results. And as I said, the first thing we'll do is I'll just quickly, we'll try to replicate the results in our own data, okay? So the first remember is the disparity in the take-up. So that's the highlighted results here. So condition observables, Black-owned firms are 9% less likely to receive these PPP loans. And then there's this reliance on fintechs and less reliance on banks. So conditional on receiving a loan, the probability that a Black-owned firm will receive a loan from the bank is about 9% lower. Okay? And then finally, when we interact the variable black-owned firm variable indicator with our bias measures, and we have bias measures of implicit bias and explicit bias, then we find that there's a negative correlation between bias and the disparity. So specifically what this means is, so one thing I should mention, the bias measures is standardized. So the interpretation of this result is that if you have in a county which is biased one standard deviation more than the average county, a black-owned firm is 11% less likely to receive the loan, okay, which is a very substantial effect. However, the average disparity remains the same. Okay, so these are the results which are in the literature, and we are able to replicate them in our data, which is nice, given that we're using different data. Okay, so now we kind of get to the meat, which is the application, the approval. So now looking at the application stage, we find that black-owned firms are less likely to apply for PPP, and observables explain a lot of this variation, but there's still about a 5% effect, which cannot be explained. Then relationships, you naturally think about relationships. One of the other papers here talked about pre-existing relationships. So I should mention the relationship variable that we have is at the time of the survey. So there's a concern that the relationship may pick up just the relationship formed at the time of getting the PPP loan. It may not be a pre-existing relationship. But given that, we find that the relationship is important and in the direction that we think, but they do not explain the disparity. Okay. Okay. So now these are the results on the sorting. So black-owned firms are less likely to apply for bank and more likely to apply to fintechs. Okay. And again, these results are not explained by relationship with the bank. Okay. To what extent are these results, can these results be explained by measures, racial bias measures? So we were surprised that on average, for the aggregate of PPP applications, we do not find an effect. However, for banks, it's clearly the case that this disparity in applications is greater in more biased countries for banks. And so that's sort of consistent. But again, the average disparity is not explained by the racial measure. Okay, so what's driving some of these behaviors in application? So we have a set of results which is look at the reasons why the borrowers do not apply. And this is kind of interesting. So first, it could be demand. So it says like, you didn't apply because you didn't need the fund, or because you don't want to get money from the government. Black-owned firms are less likely to say that. Then it could be eligibility. Okay, that doesn't seem to be make a difference. This is kind of goes to this administrative burden idea that black-owned firms are more likely to find the program confusing, they were not aware of it, or they missed the deadline. Okay, so this kind of speaks to the fact that these administrative burdens could be potentially important. Okay, now quickly getting on to the approval rates, again, disparities in the approval stage, 8% less likely black-owned firms to receive, to get approved. And this is kind of, I think, like maybe one of the key results in the paper. But in this case, unlike the application stage, the disparities are very similar with banks and fintechs. So whatever the technology or other online part of it is not really helping in terms of reducing the score disparity. And then if you look at interact with racial bias measures, again, it's not really helping. Okay, it's correlated with bank approval rates, but it's not. It doesn't explain the similar disparities in approval rates of banks and fintechs. Okay, so why are these disparities so similar? It's kind of a puzzling result for us. I mean, there's no credit risk here, and the automation should help. So this is kind of the final piece of it. So are the black-owned firms more likely to turn down PPP funds? It's unlikely because it's not like they don't have a demand for these funds. Is it that they're less likely to be eligible than white-owned firms? We look at all the different eligibility things and eligibility criteria and try to quantify them, and we find that it does not really explain it. So what we're left with is this thing which we call administrative burdens, and there's a lot of reports, anecdotal as well as press reports, that this was an issue. Okay, and you know, to give you a sense of these are all the forms that you're required to fill in the application, and you can see it's pretty daunting. You know, sometimes these programs are saying, oh, it's 2-page, just fill it up. It's not the case. I mean, there's a lot of requirements here. Now, this is the last thing, and I'll finish with this slide. So one way we can actually document this idea of administrative burden is to look at whether a firm gets less than what they requested for. So you requested for $20,000, you got $15,000. Now, the loan amount calculation is pretty formulaic. Okay, there's a formula, you plug in the inputs, you get a certain amount. That's the maximum amount eligible, and that's what you apply for in most cases. So we think that if you get less than what you applied for, then it's very hard to explain that with anything other than there's an administrative burden. Because there cannot be eligibility because you're getting something, but it's just that you're getting less than what you applied for. So if there's disparity in that, it has to be something to do with the administrative process, the application process. And this is the last result, and you show there's a huge disparity between black and white. Black-owned firms are about 20% less likely to receive less than what they ask for. So we think like this is a really convincing result, and this is not explained by racial bias. Okay, so I'll conclude. I hope I'm more or less on time. So we look at application and approval outcomes. And the fact that fintechs are not, so we find this sorting at the application stage from banks to fintechs, but at the approval stage, the disparities are very similar. And we think that administrative burdens are kind of a reason, and we need to understand this better. One open question is, if the fintechs are helping, it's helping at the application stage by expanding the pool of applicants, but why is this the case? And that's an interesting question for further research. So thank you very much.
Thank you very much. We now have discussant Rachel Marie Brooks-Atkins. Hi. From St. John's University, sorry.
I'm standing between you and lunch or the end of this, so I'm not going to take too much time. But I just want to thank again the organizers of this amazing conference. I've learned so much over the past day and a half. And I was really excited to have the opportunity to look at this paper. For anyone who has done any exploration of the PPP program, you may be well aware that there's this whole literature that looks at racial disparities in the observed allocation of PPP funds. We can see bank loans that were provided and also loans to fintechs and other types of lenders. But we don't have any information from the SBA data on applications or how applications, conditional on having applied, how that affects racial disparities in the actual loan approvals. And so this paper fills a huge gap in the literature, and it's for anyone who's looked at it, it's a really, really huge contribution. I'm not going to spend too much time summarizing, but the main questions, they look at whether the racial disparities in the PPP, whether there are disparities in loan applications, and if so, do these explain racial differences in loan allocation? And they find yes. They also look at whether there were racial differences in the PPP loan approvals, and if this is driven by disparities in applications or by discrimination. And they find, again, yes. In other words, they find evidence of both. And then lastly, they try and get at this idea of whether or not what we're seeing is driven by sort of selection versus approval, and they find evidence of the selection effect, which would be, yes, there's this selection into fintechs versus banks, and it's all so helpful in helping us better understand the disparities that we've observed already in the PPP. They use linear probability models. They do a lot of really great data work. And importantly, they sort of place, as was already noted, that should say Chernenko produces the estimates that were already found in these other papers, Sharfenstein and Howell. And so it makes it more convincing that what they're doing is actually giving us a peek into the mechanisms that underlie those other results, because they were able to use their data to reproduce the results that they found. So again, I just think this is really a well-done paper. I have very few sort of suggestions for how the analysis could be maybe enhanced, and then a few, if I may take the liberty, a few sort of provocative questions in light of the theme of this conference being inclusion, of how this might be reframed to orient us more towards equity and inclusion. So I know I don't have a lot of time. So the first thing was, and I don't know if you even talked about it, but in the paper there's a table where you show applications and gender, and they show that there was actually a greater probability of applying to the PPP for women, or for your respondents who were female. And so it begged the question for me, what would happen if you disaggregated your results by gender? And would we see, for example, a larger application disparity for white men versus black men? How much work is gender doing versus race? So, that's one. The other is, since this, now I know this isn't longitudinal data, but this is a survey that takes place sort of annually. So I wondered if, in order to isolate this question about the application frictions, if this is a PPP specific thing, or if this is a more general thing we can learn about applying for bank loans. If you could compare some of those responses about the reasons people didn't apply for funding in prior surveys before PPP, just to see if you get those same rates of like it was confusing. The answers to those kinds of questions might help us understand how much of this is PPP specific versus just a general difference in administrative burden. First time, I'll skip the last one. Okay, so reframing for inclusion. I will say I read an earlier version of this paper, and I think you all actually did this. I think that you started to move much more in this direction, so I really applaud you. I don't know to what extent, even being involved in a forum like this caused you to think about, this idea more, in which case, again, I just applaud this conference. I think it's great. But I would argue that you could go even further in a couple of ways, and I just want to really quickly motivate why I think that's important. You situate this in the academic literature really effectively, but I think it's important to remember that we're not just in academic conversations, right? We're in these conversations that are taking place, public discourse about these issues. There was a New York Times article, the producer of the Black Panther movies revealed that he had been just trying to take his money out of a Bank of America branch, and they called the cops on him and said that he was robbing the bank. And so, I don't know, that might be a reason for me to switch to fintechs if I'm him, right? So this paper could very easily sort of speak into this kind of public discourse. So this other article is a Manhattan Institute article where the author is kind of trying to talk about how he thinks about disparities in the US, and he kind of does this thing where he says, he sort of acknowledges the existence of discrimination, but then also says that he thinks that there are a lot of problematic behaviors that need to be sort of addressed by Black people because they are sort of the ultimate cause of the disparities that we observe. And so while I do not think that that is in line with what your paper is saying, I do think that there is a world in which someone reading this paper might see that. They might see sort of a acknowledgement of discrimination, but also these behavioral differences that help to describe or explain, so to speak, racial differences, and then continue to orient us in a way where we put the onus of inclusion on marginalized groups. So how might we reframe this a little bit to think more about inclusion? We can think about who is the object of our analysis, right? So we frame this in terms of take-up rates. You may notice when I kind of reframed or when I rewrote the question a few slides ago, I always use the word allocation. So we could think about who's going to bear more of the burden, or who should societally bear the burden of making sure that these programs are inclusive. Is it the people who are being asked to apply to them? Or is it the agencies and the institutions that are implementing and designing these programs? And so there's a way in which you might think about framing this as an examination of how inclusive and equitable the PPP program is. And these are some mechanisms that explain why it wasn't. I would say also, when I read the paper, and again, the authors, to their credit, they actually did move more in this direction in the later draft that I read. But I really took away primarily these the illustrations of ways that this application friction story spoke into the sort of structural and systemic ways that inequality gets reproduced. Because I think that a lot of people hear words like systemic racism, they're like, their eyes just glaze over. But this sort of thing really illustrates how that happens. And I think it's really important for this kind of thing to be in our public discourse. And it also shows, using the impact implicit data, that we're not just talking about legacies of discrimination, we're also talking about present day discrimination. So I think that's also important. And then finally, there are a couple places in the paper where you give these sort of conjectures about what might be going on that I think you could actually use empirical literature to support. So for example, you give some examples and you do use the, that last slide especially that you showed with all the forms that you needed in order to talk about the administrative burden. I think all that's great, and you sort of also do some conjectures about how you imagine that might work itself out in the real world. Well, there's this audit study by Bone and co-authors. They actually had been doing these audit studies of bank branches with matched pairs of Black and white fictitious business owners to see whether and how they were treated by bank loan officers. And it just so happens they were continuing this, and then the PPP happened. So they actually have data from the PPP period. And they find differences in levels of encouragement in applying for loans. So the bank lenders the loan officers sort of encouraged the white testers to apply more than the Black testers. They find differences in which products were offered. So in some cases, they didn't offer the PPP as an option for the Black testers. And then they find differences in the level and the types of information that they wanted the tester to provide. And in some cases, they were asking Black testers for information that legally they're not even allowed to. So I would suggest maybe using some of this more empirical evidence to help bolster what you're talking about in the paper, sort of just conjecturally. So that's all I had. Thank you so much again to everyone for putting this together. I don't know how to take that off.
Thank you so much. What thought-provoking end to this part of our conference before the closing remarks. Asani, do you want to go back at all to anything from the discussion?
No, I just want to thank Rachel on this excellent discussion and think about it. So just want to mention something like.
Do you have a mic?
So just one factual thing I just want to mention is that in the survey, not all of the questions. Thank you. So the survey is sort of more general. It happens every year, but in this particular year, there was a specific module for PPP. So some of the questions that we use as data is very specific to PPP. So like for the administrative burden part, those questions that I showed, they're not available for the other years, unfortunately. But great comments, and we'll definitely think about it. Thank you.
Super, thank you. And I suggest we leave other questions for lunch. So before the concluding remarks, let's show some appreciation to our guest speakers.
Shall I? Yeah. Hi. Yeah. So it's time to close this very productive conference. And it's also time to start thinking and looking forward to the next edition of the conference that is going to be hosted by the Bank of Spain in Madrid. That's why it's a great pleasure to have today Governor Pablo Hernández de Cost giving the closing remarks. And I have been asked to be very brief, but I can not resist to add a personal note to this presentation. And so let me illustrate with a very small example, a very tiny example, Pablo's commitment and support to both research and research-based policy, as well as diversity, equity, and inclusion. And the example is very simple. I am involved in a research project at the Bank of Spain with two researchers there, Laura Ospido and Olympia Bober. And we are looking at different aspects of gender balance at the Bank of Spain. And it was precisely Pablo who encouraged us to do this project. And he was really supporting the project, encouraging us, but also instrumental to get the data and to facilitate us access to the data. So without any further delay and given the time pressure, please join me to welcome in virtually Pablo Hernández de Cost, Governor of the Bank of Spain. Thank you, Pablo.
Thank you very much, Anna. And you perfectly know that I have great expectations for
From
the
that
use
project.
of this data. I guess you know that we will condition all our internal policies in terms of diversity to the outcome of the research project that you've started. Okay, so let me, of course, say that it is a great pleasure for me to bring this conference to a close, and let me start by stating the obvious, which is the importance that we all pay to this topic. I guess it's also obvious to all of us that for central banks, we traditionally have been concerned with aggregate considerations, most notably in terms of the impact of inflation and financial stability, but in the wake, in particular, of the global financial crisis, and with growing concerns about the consequences of that crisis on social and political issues, research started to look not only to the aggregate, but also to the implications of monetary policy for income, for wealth, and also for consumption inequality. And I think the conclusion of all this research was that the aggregate effects of policy are relevant, but are not sufficient to obtain a complete picture of the implications of such policies. More recently, I think we are living a kind of a second wave of research that it is going even further, showing that monetary policy may affect not only aggregate variables or even the distribution of income or wealth, but also may have differing effects for different demographic groups, for example, by gender, race, or educational level. And the importance of these issues has been recognized, among many others, by the Federal Reserve, which has stated, for example, the need for monetary policy makers to understand how various communities are experiencing the labor market, just to give one example. Interestingly enough, this growing interest on distributional impacts of monetary policy has its root not only on fairness considerations, but also on the implications of this inequality for growth, for productivity, for example. And let me mention, for example, this paper by Hechet and co-authors, in the paper that they published in Econometrica in 2019, in which they provide striking evidence in this regard. They start with the observation that in the US, 94% of doctors and lawyers in 1960 were white men, while that fraction was just 62% still in 2010. And given the innate talent is unlikely to have changed differently across groups in such short period of time, this suggests that a substantial pool of talented women and black men in 1960 were not pursuing their comparative advantage. The authors study the implications of this and find that between 20% and 40%, which are very big numbers, of growth in aggregate market output per person can be explained by the removal of obstacles that hinder the optimal matching of talents across the population. So this is, for me at least, a very good example of the implications of the lack of diversity, of inequality more generally on growth and productivity in particular. We have heard some excellent examples of this emerging literature in the first part of this conference, but we also know that the distributional effects of monetary policy are just one aspect in the diversity and inclusion components of central banking. And the second and third parts of the conference have dealt with two other key issues. The first one is how the presence of discrimination or some social norms may affect households and firms' financial decisions. And this paper by Fairley and co-authors show, for example, that Black entrepreneurs apply for loans less often than white entrepreneurs, largely because they expect to be denied credit, even when they have a good credit history, and in settings where strong local banks favor new business developments. Again, understanding the causes and possible solutions to such issues is absolutely crucial for, in this case, for bank supervisors and policymakers more generally. The second issue is that we, as economists, are immersed in a research and policy environment in which there is considerable room for improvement in terms of inclusion. Again, let me give some examples. Around 1/3 of the Fed's economists are women. At the ECB in October 2019, 42% of experts, 30% of managers were women. There is also evidence, research showing that women in economics are subjected to harsher standards than men for publication or being even accepted into conferences. And again, this is important not only for equity reasons, but also for efficiency considerations. There is evidence that considering a diversity of perspectives, a diversity of ideas leads to better decisions in an organization. And since opinions among economists about policy are heterogeneous, the prevailing views may be biased by the relative underrepresentation of some groups, meaning that we might be taking wrong decisions because precisely of this bias. In sum, diversity and inclusion are inevitably intertwined with central banking in at least three ways. First, monetary policy may have differential effects across different population groups. Second, the existence of gender, racial, or other demographic biases may affect households and firms' financial decisions. And third, a lack of inclusivity in our work environment may hinder research quality and decision making. So as we've seen during these days, some excellent work is being written on these issues, but I think the main also conclusion, for me at least, is that we cannot be complacent. Much more is needed, and conferences like this one are a useful tool, a useful way to stimulate future research and to signal to the economics profession and to society in general the need for such work to define the pathways going forward. Before I conclude, and it was also mentioned by Jana in her introduction, let me also say that it is a great pleasure to announce that the next edition of the Conference on Diversity and Inclusion will be hosted by the Bank of Spain in Madrid. The event will take place on the 7th and 8th of March 2024. And with this, let me also say that the Bank of Spain is fully committed to studying inclusion in central banking, the economic profession and society at large. Recent work by the Bank of Spain researchers has been published on very different topics related to this, such as the estimation of the gender gap in bank credit access, promotion gaps, or the child penalty in Spain. We are also in the process, as Anna was also mentioning, of carefully analyzing our own staff data to better understand the challenges to improve diversity in our institutions, and we have already committed to different internal actions, depending, of course, on the conclusions of this empirical exercise. And, of course, hosting the next edition of this conference will be the best example of another example, at least, of this commitment. So let me just thank you to those who organized the event, to the speakers, and to all the participants who took part in it, either in person or virtually. And of course, we look forward to welcoming all of you in Madrid in 2024. Yes, thank you very much.
Thank you, Governor Hernandez de Cos. This actually officially concludes the conference on diversity, equity, and inclusion in economics, finance, and central banking. However, before we all leave, I would like to thank Governor Macklin for the opening remarks and also joining us today. And thank you so much to all the presenters and panelists who shared their work and views over the past day and a half. And of course, many thanks as well to our attendees for your participation and excellent questions, although we couldn't take as many questions as we would have liked today. But it was really nice to have conversation with you also outside the conference room as well. And we appreciate you all making the time to attend this event, and we hope that you have gotten some useful inspiration from this. And last but not least, I would like to thank the organizing committee for putting together a really inspirational program, and also everybody who really made this conference possible and made it work flawlessly. So thank you so much. Have safe travels, and we'll see you in 2024 in Spain.